Very good to see many of you again, and for those who came today, ahla wa sahla. So today is the second session of the workshop. We're still continuing the discussion on investment readiness. We covered, as you remember, last session, the journey of investment readiness, and we went through the pitch deck, we went through the funding sources, went through the capital structure, the transformation journey that would lead you to be ready and face investors. Today the focus is more on finance. So financial management, financial statement analysis, the basics of it, financial ratio analysis, financial modeling, how to build a robust financial model with the projections for the 3 to 5 years, and finally the company valuation. So for those of you who might be considering an issuance of equity at a later stage, how do you value your companies, how do you value your organizations? I'll just pause. Constantin would like to say good morning. He's in Switzerland, so he's connecting remotely. Constantin, try to speak لنشوف إذا بنسمعك.
Can you hear me? Lama, can you hear me?
We can hear you, بس علي صوتك زيادة شوي بس لأنه الصوت واطي.
Okay, very good. Look,
Can you hear?
Good morning, everyone. Is the voice clear, Lama?
Somewhat.
Okay, so look, it's just want to welcome you, and I'm a few tips on it. First, I would like to thank Al-Fanar and German GIZ for their trust in our drive to be able to add value to the entrepreneurial ecosystem in Lebanon. This has been at the core of what we have been doing, as some of you know, in terms of not only providing advisory services, but also in terms of sitting on the board of a number of the companies, and most importantly is also providing funding to you, because today funding is a scarce resource. Banks are not operational, a number of funds have disappeared, so we're very, very excited to be part of this program. Now it's a bit tense and it's a bit rushed in terms of 1 month, but the demo day that you'll have on September 3rd will provide you a great opportunity to meet with a number of investors, business angels, diaspora, people like ourselves who are interested in wanting to support the ecosystem. My message to you is, today is in some ways, for some of you, it's a dry subject. It's about the basics of financial management. But this is an essential language. No matter what you'll be doing in your life, whether you're running your own social enterprise, whether you'll be part of a department in another organization, whether you're running an NGO, whether you're running GIZ, whether you're running Al-Fanar, you need to be able to speak the language of finance. Because at the end of the day, whatever you do, all the activities that you end up doing have an impact either on the income statements or on the balance sheet or on the cash flow statement of your organization. And the more you're in top of your numbers and the financial situation, the better off you are in running your company. So my recommendation, even if you get 10% of what Lama is going to cover, and we'll make sure that you get more than 10%, what I would like you to do is to embrace it. Be open to it, and it's a learning process, and over a period of time you will be able to grasp more, moving from 10% to 20% to 30% to more. So it's a gradual learning process. This is the first message. Embrace it. The second message is have someone in your team, either on your advisory board or in your team, who understands this language and who could help answer whatever questions you have. Because no matter what you do, and I've covered this during the previous session, 80% of all the topics discussed at board levels are all related to financial management, being it approving your budget, approving audited financial statements, approving investment opportunities, approving dividend payments, approving grants, approving investments. All of those have an financial implication. So my recommendation, get yourself someone who understands this language, been through it. The third message is take it as a learning process. Take it as if you're learning a new language or learning a new musical instrument, and the more you get to know it, the more you're going to realize how important it is in your day-to-day life. So embrace it, get support, take it as a learning process, and you will see that in 5 years, 10 years, or 15 years down the road, all these templates that Lama will cover with you, that we have covered during the previous session, and then we'll cover during the one-on-one with all of you, you will see that these templates, you'll be using them in the years to come. So you're in great hands with Lama. I'm extremely thankful for Alfanar, of course, for GIZ, and for Lama to hold the fort during my, I'll be with you on the call, taking whatever questions that Lama feel that I could provide any feedback. Enjoy the ride. It's going to be a great one, and you're in wonderful hands. Lama, thank you. The floor is yours.
Thank you, Constantin. So just as a reminder, so remember, this is the investment readiness journey that we covered during the previous session. So we went through the gap analysis, we looked at the business model canvas, we looked at the transformation plan from which we got what are the growth opportunities, what are the core competencies that we can build on, what is the strategy, what is the vision, what is the mission, what is the value proposition, what is the product offering, does it still hold the ground, and what is the way forward. From the combination of those first three phases, we said we will be able to build the financial model. Now, to build the financial model, some of you don't have the background in finance to jump immediately to the financial model and to the projections. So bear with me, we will cover the basics of financial statements, the three financial statements. That will be the basis of the financial model and over the forecasted period. After covering the basics of financial statements, we will do the financial model. So how to build the forecast over the 5 years, and from the financial model, we'll get to the valuation methodologies that we can use to value the company. Please. Yes, Joanna, can you please give her the Wi-Fi password? So, Constantin mentioned this during his intervention. So, why do we need financial statement analysis? Whether you hold the role in finance, whether you're the founder, whether you're leading business development, whether you're on the board of the company, you need to understand how the company is running by looking at the numbers. And when we look at the financial statements, we will understand how the company is performing from a profitability point of view. So how profitable it is, what are the margins, the gross margins, the net margins, what is eating from those margins and leading to the profitability that we have, how efficient are the operations, what's the liquidity situation in terms of cash on hand, and so on. We'll know how to allocate resources. So having the numbers, seeing the income statement, we can know if we can still allocate resources, human resources, salaries, technological resources, whether we can invest in new technology, and so on. For strategic planning and projections, as we will see now, and whenever you're communicating with your stakeholders, with your board members, with your shareholders, with your suppliers, with your customers, you need to be to have the grasp of all the financial data that you have. The other thing is, during board meetings, all those topics that are discussed during board meetings, they all revolve around finance. So audited financial statements that are approved by the board, this is finance. The strategic plan and the financial budget, the dividend policy, the annual compensation plan, approving funding rounds of debt and equity, hiring and compensation. So all those topics that are usually covered during board meetings, you need to have a good grasp of finance and understanding of finance to be able to join the conversation. So we start very slow. For those of you who have worked with financial statements, bear with me. We will cover them, take them as a rappel, as a reminder. And for the rest of you, we will take it slowly so that you get out of the session with a good understanding of what are the basics of financial statements. When we say financial statements, we refer to three financial statements: the balance sheet, the income statement, and the cash flow statement. We will cover one by one, and we will have a few questions at the end just for us to make sure that everything is clear. So we start with the balance sheet. The balance sheet is a position. It's a position snapshot at one point in time, usually at the end of the year. What is the financial position of the company or of the organization or of the NGO or of an individual even? So what does it say? It says, what do you own, which we call assets? What do we owe, which we call liabilities? And the net between them is what is the shareholders' equity, what remains in the company. This is the value of the company. Under the asset side, a typical example of assets are cash that we have, receivables that we have. This is when we're selling on credit. So when we're producing something, we're selling it, but we're not receiving cash for the delivery of the service. We're giving credit terms for our customers. When we make the sale, this is a sale that we do, so we recognize it. Even though cash has not come in, this is an asset that we own. This is something that we have ownership of, and we put the amount under the current assets part of the balance sheet. Inventory, the stock that you have, this could be the raw materials that you have purchased to start production. This could be the work in progress that you have, and it could be the finished goods that are sitting in your warehouse on your shelves. And then you have the longer term assets, which are plant, property, and equipment. These are the fixed assets of the company. This is the warehouse that you own. This is the land that you have. This is the office space that you have purchased, not rented. So this is asset to the company. This is what you owe. On the other side, we have the liabilities, and liabilities are what we owe others. And who do we typically owe? We owe our suppliers if we haven't paid them cash when we purchased the raw materials from them or the supplies from them. We owe banks. We owe debt holders when we borrow from them money. And some other liabilities could include the tax payable that we haven't yet paid to the legal authorities, which are dues. So everything that we owe, we put it under the liability side. And then the last one is the owner's equity. Typically, what does it include? It includes the accumulated profits that we would have generated year over year, which we call retained earnings. And of course, it includes the paid-in capital that we have put in the company when we first incorporated it or established it, and any future equity rounds that we had down the line. So the idea about the balance sheet is that it has to balance. So the asset side is always equal to the liabilities side and equity side. Okay, so liabilities plus equity should always equal to assets. If it's not, then there's something wrong with the way that we accounted for entries. Clear? Is it new for any one of you, or is it have you all? Nos. Is it?
Are you saying the assets should be equal to liabilities and owner's equity? It can't be negative or positive. Can it be liabilities?
You can have a negative equity. You can have a negative equity if you have accumulated losses over the years that were more than the paid-in capital that you have. The equity side could be negative. The equity.
So the balance sheet as a whole.
It always balances assets from one side, liabilities plus equity from the other side. Yes. Yes. Okay, so let's take your organization and let's think what the balance sheet of your organization looks like. Okay, so do you have cash?
Yes.
Okay, so on one side of the balance sheet, let me maybe. So you have the asset side, the liability side, and here you have equity. This side should equal this side. Okay? So you're telling me you have cash. Okay, so your accounts receivables are 0. Yes, please. Please, thank you.
I own an organization called Espace Fun. It is a school of design and creation that closes the gap between expensive universities on one side and small, tiny, cute workshops on the other. What we do is we offer university level education at the price and entrance, no entrance basically requirements of workshops. We are a workshop setting, but university level education.
Okay.
Okay, so that's what we do.
Okay, so when you charge, you're getting cash.
Exactly.
Okay.
إنه نحن بيجوا لعنا بيدفعوا أو OMT أو cash.
Okay.
أي.
So you don't have accounts receivables, you don't give credit terms. So your accounts receivables are 0.
Yes.
Now, do you have, in your business model, it's a service delivery, not a product delivery.
Absolutely.
So you don't have inventory.
Inventory,
Inventory is stock.
We have inventory in terms of supplies. And we provide the tools and the materials. So we have an inventory of مثلا paint, of metal, of عرفتي?
That you sell?
No, we don't sell. We use them in classes.
Okay.
عرفتي شو قصدي؟ بس we stock them.
Okay.
يعني
But whatever you have under inventory is usually هلا we can consider it the raw material of your service delivery.
إنه is
yes,
this
yes.
inventory ولا is this هيدا هول الأشياء اللي
if I'm taking your example saying that the material that you use is the raw material for the delivery of your service, I can use it as
exactly.
as stock. Okay.
Exactly. هيدا
So
كمان
here you will have your
بالنسبة لإلي
inventory.
هاي الشغلة مثلا منا واضحة. عرفتي شو قصدي؟
You can use it.
This is where it gets mushy.
Because it's a system of service delivery as opposed to
it's not
product
as
delivery.
straightforward as إنه عم جيب مثل عم بيع صيغة.
But given that this service requires these assets, then they are part of your.
Yes, especially إنه we provide the tools as part of the class fee. People don't bring tools. يعني نحن we have يعني they are part of the service that we offer.
Okay. The other one is equipment. So depending on the nature of these supplies, you can either put them under equipment. So if it's a machine that does sewing, if it's you put them under equipment, then the things that you use for the machine to make it operational, because they are part of the service delivery that you can put some of them here.
So مثلا الخيطان والإبر بيروحوا under inventory والمكانات under equipment. Okay.
And then you have here what we call PPE, plant property and plant and property basically, which is if you own the workshop.
The space. It's a rental.
So it's 0 for you. So do you own, under your organization, do you own any land, any apartment, any warehouse? So it's 0. So this is the asset side of your balance sheet. هون laptops, furniture. هلا بنفرجي example furniture, laptops, the whole everything that you have that you own, that you purchased and that you own, it's here. Yes. These are parts of the assets of Veritech. So these are not equipment, but these are objects that are part of the assets. So this is what we call office furniture or something like this.
If they had heavy machinery, maybe like a production line or something.
Yeah.
It's a long-term asset, something that they can sell off in a moment. Is that equipment or is that?
You can put them under ما هو the current assets, they stop here, and then here PPP is fixed assets. So these are the long-term assets. So you put them here. So machines are here, equipment is here, laptops are here, and those are the ones that are depreciated. هلا بنشوفها. So these, because they are long-term, because they are used, and when they are used, they are losing their value, some of their value. We apply a depreciation on them, just like your car. You're using your car, it depreciates with time. So everything that is long-term assets is depreciated, and then the depreciation expense will affect the other financial statement, which is the income statement.
Okay.
Okay. So we continue. Do you have any liabilities? Have you borrowed from any party, from a
No.
bank, from an institution?
No.
Okay. Do you have money that you haven't paid yet to your suppliers?
No. نحن إجمالاً we purchase هيك مش إنه we purchase in stock. We purchase what we need for the class. So
Okay.
إجمالاً it's like
And when you purchase, you buy.
we pay دغري.
You
Yes.
pay دغري. So you have zero liabilities. You have zero debt. The equity here is the paid-in capital that you put in first. So المساهمة تبعولك.
okay.
Okay. So the paid-in capital, and then if you have generated gains,
Okay.
are you profitable?
Yes. يعني
Were you
yes.
profitable before and
وقت الأزمة لا بس
Okay.
بس
So
هلا
the
الحمد
profits
لله
that you have generated since inception until today that you haven't distributed are part of your retained earnings بنسميهم هون. Okay, these are accumulated profits that you have generated since inception, since you started, that
Okay.
haven't been distributed.
Okay. Okay, sounds good. لأن مزبوط هن لأنه هن شقفة منهم راحوا بالinventory، شقفة منهم راحوا بالequipment للcapital، والباقي ضل كاش. So مفروض هن they add up.
Hi.
Yes. Okay, شوية أوضح براسي لأنه بس أنا شفتي لأنه things are not as straightforward لأنه we don't deal with إنه payables وما شو. It's just
Going back to the advice that Constantin gave at the beginning, you need all of you to have a finance person with you on the team. You need all to understand the financial statements. You need to be able to read them. You need to be able to make decisions based on them. But you need also an accountant, a finance person to take care of those questions for you and to tell you, this is the balance sheet of your company, this is the income statement. You understand how it is, but you don't have to do it yourself. You don't have to have the know-how to do it as an accountant would do. And then you need to analyze it, you need to make decisions based on it, you need to improve your operations to be reflected on the financial statements, but have all of you have one person who is in charge with the accounting and finance to take care of the accounts on your behalf.
هلا نحن we do هلا.
Okay.
من ورا الفنان على فكرة.
Okay.
عم بدرس معه. عرفتي كيف؟ يعني literally عم بدرس معه.
And it's a journey and it will continue. يعني ولا no one will suddenly become you know the chief finance officer of the company from one day to the other. This is a journey. So if you don't have a finance background, if you don't have an accounting background, it's okay. It's a journey. Every time you sit with your CFO or with your accountant, you will learn something new. You will upgrade your knowledge even more and fine-tune it. But have this someone who can help you. And this could be either a full-time employee with you or also and it would be someone on your board. So you need to have on your board someone who can open your eyes to things that you need to understand, financial statement information that you need to be able to grasp and act upon.
Okay.
So an advisor, a full-time accountant with you, and it's a journey.
Okay, thank you.
Sure. So we'll move to the others. I'll show you first an example of the balance sheet. So this is how it looks like. The first item is cash. So this is a company that has $60,000 in cash, $10,000 in receivables that they need to yet collect from their customers. They have inventory of $606,000. So this is a very heavy inventory, constituting 50% of the total assets. And then they have the fixed assets. So land and building, machinery and equipment is here, furniture and office equipment is here, other fixed assets that they might have. And then, as I said, all the tangible fixed assets are depreciated. So when you put them on the balance sheet, you don't put them at their book value, you put them at the book value adjusted with accumulated depreciation, which you would have taken year after year. This is how you reach your total assets. The total assets are equal to total liabilities plus equity. What is on the other side? So this is the liabilities and this is equity. منا واضحة. So what do we have under liabilities? We have accounts payable. So this is the money that you still owe to your suppliers that you haven't paid. They have taken also debt. لا مش debt. So they don't have debt on their balance sheet. Their only liability is to their suppliers. And then here on the equity side, when they incorporated the company, they put in $3,000, but then through the years, they have accumulated retained earnings of close to $1 million, which would boost the equity side of the balance sheet. And this year, So the year that ended in December 2023, they generated profits of 160K, which they would include under equity.
This is a balance sheet. Excuse me. This is a balance sheet of the pure business.
Yes.
We're talking about NGO. What would
It's the same. It's the same.
the donations, for instance, the grant? Where do they
The
go?
grants would go to the income statement, not to the balance sheet, because you don't own them. It's a revenue that you received. Usually you would receive it as part of a service delivery, but here you received it because you have the impact that you deliver. Donations are also part of your revenues. Hala, we will see them as other revenues in the income statement.
They wouldn't go under cash, for instance. If they
Bala,
have cash.
bala.
But this is what I mean.
They will be reflected here because every accounting entry needs to be a debit and a credit. So when you receive a donation, your cash balance would increase, and your revenue will show that you received a revenue, another revenue part as a grant.
Yeah.
Okay, so the accounting transaction that you do is cash would increase and revenues would increase. So, but it will not be shown here. I mean, it's not part. The grants are not part of your equity. But your investment in the company is part of your equity. If you, as an NGO, you have the right to take debt. You have the right to borrow money, to take debt. It will show here. So this is why I started by saying it's the same. The balance sheet of an NGO is the same as the balance sheet of a corporation. It's the same as your balance sheet. If you were to say what is my balance sheet as an individual, I have this amount of cash in my bank account, I have the car that I own, I have the apartment that I own, I have liabilities because I have a credit card and I've taken a car loan. So this is your liability side, and the equity is whatever is the difference between the two. Okay? So this was an example of a balance sheet. We move to the second financial statement. So there are three, okay? Balance sheet, income statement, cash flow statement. The second one is the income statement, as opposed to the balance sheet, which is a snapshot at one time at the end of the year. Typically, the income statement is a flow. So during 2023, what was the flow of income and what was the flow of expenses? The money that came into the company, not cash, money, revenues that came to the company, and expenses that went out of the company. What do we have under income? Usually it's sales, whether you're selling a product or you're selling a service, and the other revenues like grants. So you put them as income in the income statement. On the expense side, you have the cost of goods sold, which are the expenses that are immediately related to the delivery of a service or to the production of a product. So if we take the sewing example, let's take the olive oil example, the cost of goods sold is the cost of the production of this bottle of olive oil. So you're selling the bottle of olive oil for $10. It costed you in terms of the actual raw material, the olives that you pressed, the person who was there, so was exactly the worker that participated in the production process, the bottle itself, the glass bottle that you have, all those will go under cost of goods sold. And from the cost of goods sold, we would understand what is the margin. هلا we will see it. So what is the gross margin? قد ايه عم بتكلف القطعة أو قد ايه عم Then other expenses include the SG&A. So this is selling, general, administrative. This is all the costs that you have. Salaries, rent, marketing, legal, utilities, insurance, licenses. So everything else that is not directly related to the production or to the service delivery, we put it under SG&A. And then of course, if you have borrowed money, you have interest expense, and you have, if you are profitable, you are paying taxes. So taxes and interest are part of the expenses. Very simple. Total income minus total expenses will get you to the bottom line, which is the net income. Net income or net profit. Okay? Any question? So let's continue with you, and let's do the example for the income statement. For your income statement, you have what are your revenue streams? So you have your course revenue. Any other revenue? Are you selling?
The work of our students and instructors, so boutique sales.
So boutique sale.
We have a kids program, Makarem.
This is membership. This is
كمان يعني إذا بدك under course we have several types of offerings.
okay. So here you would have different revenue streams under that.
Exactly. لأنه
Okay.
في شيء workshop في شيء kids في شيء.
Okay.
We do sometimes business to business activities يعني مثلا we give a workshop in عقار with
Okay.
um,
Okay. So hole, these are
sorry.
yes.
We also rent sometimes. We rent one of the we rented one of the rooms we have 4 rooms.
Okay. So rental income. Okay. Now the cost of goods sold. We need to look at each one of those revenue streams and see what was the cost behind it, directly related to it. So for the course revenue, exactly, you have the teacher salary.
Floor manager.
No, the floor manager is not directly related. So هون رح يكون في salaries وبيناتهم في الفلور manager. للبوتيك سيل عندك الرو ماتيريال اللي في supplies that went in, that went here. اوكي بس those supplies ما بقى فيهم يكونوا بلا فيهم يكونوا بلا. So you have the supplies, the raw material حسميها. Not here. هلا بنحطها تحت. حنسميهم raw material. الكلينكس سناكس هو اوبكس.
هنا بس بيروحوا بقلب الصف.
اوكي بس كلينكس usually it's part of I mean ما بتستعمل كلينكس.
ما بياكلوا سناكس.
لا السناكس اوكي. السناكس it's because you're offering snacks as part. Okay. So this yes بس عمول general supplies تانيين it's so this is your cost of goods sold. من هون revenues minus cost of goods sold we reach some an intermediary line which is what we call the gross profit. Okay, and this gross profit, if I divide it by the revenues, will give me the gross profit margin, which is a very key ratio to look at. So the gross profit and gross profit margin as a percentage of sales. Okay, after this, I'll start deducting all my other expenses. So other salaries.
Yes.
Okay.
Salaries,
What else do you have? You have the rent.
We have the rent. We have electricity.
So utilities.
Repairs.
Maintenance. Okay. Other OPEX that were not included here will be included here. And here we reach another intermediary line which we call the EBITDA or operating profit. After EBITDA is earnings before interest, tax, depreciation and amortization. After this we deduct depreciation of the machineries. Okay, so منشيل depreciation نوصل ل EBIT, earnings before interest and tax. We remove interest if there's debt, نوصل ل EBT, and we remove tax and we reach net profit. And here also I take net profit as a percentage of sale, and this is the net profit margin, which is another ratio that is important to look at. So in your case, do you have depreciation? Yes, خلينا نكمل. So هون وصلنا للإبدا, which is your operating margin. This is two different names for the same thing. What does it mean? It's earnings, يعني income. Yeah. So you remove depreciation. You have depreciation expense because you have your machines. Correct? Then after you remove depreciation, you are at EBIT, earnings before interest and tax. If you borrowed money, هلا انت هون طلع ما عندك liabilities, so ما عندك interest, بس في tax, بتشيل التاكس توصل للنت بروفيت اللي هو النت income. مش بعدها, هو النت income if you divide it by sales, you get your net income margin. net profit margin. This is the return. So إذا أنت السيلز تبعولك revenues تبعولك كانوا 100، إذا النت بروفيت تبعولك كان 5، يعني أنت النت بروفيت مارجن هي 5%. So you start with 100
بعمل 5%
من revenues. So this is how profitable you are. And this 5 could be negative. لأن فيه يكونوا revenues لما تشيلي منه ال cost of goods sold and deduct all the OPEX, maybe you will reach a negative. You are loss making. Maybe the net profit is a negative amount. Okay, and then your margin is a negative 5 or a negative 10% or a negative 20%.
اللي عم نشتغل معه الفاينانشال ادفايزر عم يمشي معنا بالعكس، عم بيقول لنا انه نحن لازم نقرر قديش البرسنتج لازم يكون من يعني هذا البرسنتج
in terms of pricing. Okay, so again, why do we use financial statements to make decisions? So once you are operating and you put your income statement for the month of July, and you would say, okay, in July I made this much in terms of revenues, and this is my operating expense structure. So it's resulting in losses. So you need to change things to improve on your net profit. So either you reduce your OPEX, because here there might be some efficiencies that you can gain from by reducing salaries, by negotiating your rent agreement, by installing solar and reducing your utilities. Absolutely, this is one part. The other part is looking at competition, looking at the value of the service that you have, looking at the customers' propensity to pay more or less, and you revise your pricing strategy accordingly. If you do this, the revenues will increase. So the net profit will increase not because you reduced only the OPEX, but because you improved your revenues. And this is a discussion that you need to be having as a founder, as a person, as a manager of your company. No, go ahead. We're all benefiting from the questions.
So we are working with this person, and he is we are calculating هذا عم نعملها in detail.
Yes.
Calculating every bit of information to see if we are making or losing money. And then he's telling us you have to decide what is the percentage to be able to price your course. يعني مش بالعكس، مش يعني what I mean is مثلا انت هذا الاكزامبل revenue 100 النت profit 5 عم يطلع 5%. هو he's telling us we have to decide whether we want 5%, 10%,
Yes.
20%. We make this decision and accordingly
you price accordingly. But there are many factors that go into this pricing decision. Okay. بس yes, but for you to do the projections, you need to look at the current numbers that you have and see how you can improve. So what they're doing is they're looking at this margin, the gross profit margin. هو عم بيقول you need to have for this business model to make sense and to be financially sustainable, you need to have a gross profit margin of 20%, let's say. For you to have a 20%, given that the cost of goods sold is you're stuck with a percentage, then you need to improve on your pricing. This is the thinking behind it.
Why is he asking us to revise the last number you came up with?
It's not the last number. The last number is a result of all the above.
Yes. Sorry, I'm
لا, don't worry. No.
Net profit margin. He's asking us to revise our net profit margin. هيدا اللي ما استوعبت ليش بعدين قعدت ما هي قالت لي you're projecting.
Yes. So for the next reporting period, for you not to have the same net profit margin as you did in July, if we're looking, please ask all the questions because everyone is benefiting from your questions, and we're explaining based on the questions, so it's much better than having them on slides. So بالعكس, thank you. Please. The employee, yes. The salaries that will go here are the teacher's salary because she's delivering courses. It's a service. So the cost of goods sold, the accountant is here. The admin assistant is here. The CEO is here. The business development is here. But the teacher who is delivering the course, this is, if it was, because it's a service, if it was a production, this is the raw material. This is why you consider the teacher's salary or the salary of the person sitting on the production line and producing the olive oil. These salaries go into COGS. Usually, how do we do it? Yes.
Which there are several services.
Yes.
Together. So the employees that are there should be considered under the ECOHAB.
If there's a specific production line, exactly.
The
But
guardian, for instance,
the
ECOHAB, the guardian.
no, it's here. He's not delivering the service.
Operating the recyclables is a considered.
Take the example of the paintings that you do بأحلى فوضى. The payment that you make for the painter and the supplies of paint that the painter uses to do these, this is cost of goods sold. So the salary or the remuneration of the painter will go here.
The employee in the ECOHAB are getting salaries on a monthly basis.
Yes, I know.
Yeah, they are not hired for just that service.
Exactly. So they go under OPEX.
They go on the this is what
لا, of course, salaries are under OPEX. But I'm saying that there's a portion of salaries that we consider under cost of goods sold. That salary that is specifically related to the production process. بس ليطلع بالريكوردينج.
اوكي سريع. ناتالي كورداحي l'artisan du Liban باسكو جيت مأخر سوري. بس سؤال لمدام التيتشر اللي عم يعطي الكورس he's paid by the course or monthly basis. اوكي لكنك اندر كوجز. انا فيني اعطينا اكزامبل عندنا بالارتيزان دي ليبان بس نحن عم نخيط عبايه مثلا العبايه بنعطيها لست عايشه بالبيت يعني بتخيط بتاخذ شيء اسمه بنسميه نحن ويجز. الويجز بفوت تحت كوجز لانه اتس ريليتد للعبايه اللي عملتها. هلا عندنا خياطات عندنا بالشركه هول on monthly basis يعني بندفعهم بالشهر هول بفوتوا تحت اوبكس يعني هيدي شوي حتى نحن بالاول كنا لما بنحطهم بكوجز او بنحطهم بالاوبكس لا سو انه غيرنا الترمينولوجي صار شيء اسمه wages شيء اسمه salaries just to be sure انه يعني هيك make things exactement
هلا it doesn't change the result. It's just a classification and usually مظبوط صح صح.
لانه حسب الاكتيفيتي يعني اذا انت بتصيري تعرفي انه انا ضد الاكتيفيتيز السالاريز عم بيصيروا مور فاليو فور ماني عرفتي شو قصدي بينما يعني السالاريز عم يتفرقوا الاشياء اللي ضمن الاوبكس عم يتفرقوا على اول اكتيفيتيز.
يس.
سو كل ما بتزيدي اكتيفيتيز كل ما بتخف قديش هن عم يكلفوكي اكشن صح ولا لا؟
لا ما في شيء بيتغير. It's just a matter of where you're putting them. You're putting them here or you're putting them here. ايه شو بيتغير؟
بس بيتغير انت يعني انا مثلا I'm hiring a business floor manager. اذا عم بعطي 5 صفوف ما عم طلع حق مع 10 اذا عم بعطي 20 صف عم طلع حق مع 10
شور
شور مشان هيك بينما الاستاذ اعطيت الصف بعطيه مع 10
Sure, exactly. So it goes back to Natalie's point. Absolutely. مظبوط. لأنه you will see your operating profit margin, which is sure. One comment. When we're projecting, we usually say, so let's say it's a startup, so the same person will do typically many things, and let's assume that they are the ones who are actually filling the oil bottles, okay? But he's also doing business development, and he's also managing some part of the finance. So I will take his salary, and I will say 20% of his salary I will assign under COGS, and the rest they will come to they will go under salaries. So we do this. So we will show you on the financial modeling later. So we will say, we will list who are the jobs that we have, who are the full-time employees that we have, the salaries of each, and then what time allocation of each will go into the production or service delivery process, and we will allocate them to COGS.
I want to add something very quick here for clarity. If we're thinking of a production line, معمل بيعمل كذا ايتم. إذا بده يعرف أي ايتم عم بتربحوا أي ايتم عم بتخسروا، بده يعرف شو الكوك تبع كل ايتم، الكوكس. تيعرف هذا الشيء بده يعرف قد ايه عم بيصرف وقت والريت بير اور على مثل ما قالت هي ورا ماتيريال وكل هالاشياء، لانه هيز gonna برايس ات اعلى، رح يعطيها مارجن مارك اب. هي اذا عم تبلش من تحت تطلع لفوق مارك اب، بده يرجع يطلع انه اوكي the sale of 100 items of this بسكر whatever. So بعرف this item is profitable, this item is not. هيدي عم تسكر عن هيدي اوقات هالسيرفيس بتسكر عن هالسيرفيس. هيدي is not making me money بس لانه it's a complete ecosystem I want to keep it. So into items حتى.
Exactly. So هون إذا برجع على gross profit margin, this will indicate before any other expenses incurred, whether you have debt or not, whether you're paying taxes or not, whether you have a heavy operating expense structure or not, the production itself or the service delivery itself, how profitable it is. You will see this at this level of the gross profit. And then if I go further, I can do this for every one of those revenue streams. So for the course revenue, I deduct from the course revenue the teacher's salary, and I know for this first item as a revenue stream how profitable it is. And then I decide maybe this is the one that is making me lose money, and then I might decide to close it because either it's loss making or the revenues will not contribute. But at the same time, as if I'm making my impact through this, then this is something I'm willing to live with because I'm a social enterprise and I want this to stay, and I will compensate it with the other revenue streams like the rental income, for example. Exactly. So this is where the financial statement analysis will go, and the more, usually when you have a good ERP system, when you have all the numbers introduced into this system, you will be able to do a better analysis because you will be able to play with the numbers, manipulate, and then do the...
to the cost center of the accounting.
Any other questions? So let's see an example. So this is, they're generating revenues of 622,000. The cost of goods sold is 285, which leaves them with a gross profit margin of 54%. So the ratio here are all divided by sales, okay? And these are the margins. The OPEX, the operating expenses are here. So you have salaries, travel, rent, marketing, SG&A, and other. So the total expenses are 180,000. They represent 29% of your sales figure, resulting in an operating margin of 25%. So you had a good gross profit margin of 54%, but you have a heavy expense structure that leads you to an operating margin of 25%, which is still good. Okay? Then you deduct depreciation. Amortization is depreciation, but for intangible assets like software, like websites, like okay. And then you reach the EBIT, earnings before interest and tax. You remove the financial expense, which is interest on your debt. EBT, earnings before tax. You take out the income tax, and you're left with the net profit, net income of 71K on sales of 622K, which is a net profit margin of 11%. Okay, and looking at this income statement this is for the year 2023. Okay, so this is a flow again, it's not a snapshot. Looking at this, you can make decisions on how I want to change my operations in 2024 to improve on those numbers. So I look at the OPEX structure. I see that there's 8% of my sales, which are from the 180K total OPEX, 50K is coming from travel expenses. So this is heavy. Maybe there's a way to improve on this, make it more efficient. I might want to renegotiate the rent agreement to reduce my rent expense. Salaries are very high. Do I have a heavy HR structure? Is there a way to improve on my salary expenses? Can I look for efficiencies? So this is the kind of discussion and reflection that you would make when you see the financial statements. Questions? Okay. The last financial statement is the cash flow statement. So here we're only looking cash. In the income statement, we looked at sales that were either paid in cash or that were paid in, through credit terms in 30 days, 90 days. In the cash flow statement, we will only see cash transactions. And the way cash flow statements are built are, there are 3 buckets in them. Cash flow from operations, or cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. I'll cover the last 2 and then I'll go to this one. Cash flow from investing activities, any kind of investment happening. I buy machines, cash goes out. I sell the company car, cash comes in. So this is related to fixed assets being purchased or sold, okay? So any change in cash that is related to those tangible or intangible assets fixed that I have, this goes under investing activities. Under financing activities, I'm looking at all the financing that happens in the company in terms of debt or equity. So if I'm borrowing funds, if I'm issuing bonds, if I'm issuing equity, this is cash that will come in the company under financing activities. If I'm repaying my debt, if I'm distributing dividends on equity, or if I'm repurchasing stock, this is cash outflow under the financing activities. Usually what you see mostly is sale and purchase under investing activities, and we're not yet distributing dividends at an early stage, so we're either issuing equity, issuing bonds, and repaying the principal on those bonds, okay? Now, the last but first item is cash flow from operating activities. This one will build on the income statement. So I'll take the result of the income statement, which is the net income, the net profit that we had at the end of the income statement. I will adjust it by changes that are cash related that were not reflected in the income statement, and changes that are cash related that were reflected in the balance sheet but not in the income statement. So I'll take the net income. I will adjust it for non-cash expenses such as depreciation. You remember, to reach the net income bill income statement, we remove depreciation. Depreciation is a non-cash expense here. So I take the net profit and I add back depreciation because I want the cash part of the income statement. I don't want the non-cash. The other thing I do is that when I look at the balance sheet, when I collected receivables, okay, when I collected receivables, the receivables amount on the balance sheet changed, but also the cash changed. So any change in accounts receivables reflects in cash. If I purchased stock or raw materials in my inventory, also this is cash that went out. It was not reflected in the income statement, but it showed as an increase in inventory. If I paid my suppliers, the accounts payable on the balance sheet decreased, my cash decreased, but the income statement was not affected. So this is why we need to make changes to the net profit. So we start always with net income. We adjust it for depreciation, which is a non-cash expense, and we reflect it with the increase in working capital. Working capital is accounts receivable and inventory minus accounts payable. And this is what we refer to as the cash conversion cycle, okay? So changes in accounts receivables, changes in accounts payables, and changes in inventory, I look at the delta between last year and this year, or between last month and this month, and these changes, I add them back to the net income to reach the cash flow from operating activities. I'll show an example. So I'll do the same thing. So when you issue equity, is it cash inflow or outflow? Inflow. So this is cash inflow, okay? You issue debt, it's a cash inflow. You have a cash pool, the cash balance, I'm asking for plus or minus. So when I'm paying dividends, it's a cash outflow. If I'm repaying my debt, cash outflow. For the investing activities, I'm selling property, I'm selling a property, I'm selling an equipment, I'm selling a car, it's a cash inflow. I'm purchasing, it's a cash outflow, okay? On the operating activities, so these are cash receipts that exceed the cash expenses, so they will add to my cash balance, and the cash expenditures that exceed cash receipts will be an outflow for me. The slides? Yes, yes, of course. I'll just show. Non, non, je veux voir un exemple. So this is an example of a cash flow. We start with net profits, we add back depreciation, we reach cash from operations. We look at the change in working capital. So here, change in inventory is minus 122, which means we purchased raw material or we added to the inventory, okay? Change in receivables, minus 22. No, cash that went out, it's a minus. So the accounts receivables increased, so we sold on credit. Change in payables, 28. This is the total change in working capital is minus 109. So this is cash that went out of the company. من هيك we started with a positive cash from operations of 105, but the actual cash from operating activities is minus 109. Okay? Then we have minus 30 bill investing activities. So what is this? Acquisition or disposal of assets? It's some negative. So cash outflow. So acquisition of fixed assets. Looking here, variation in long-term debt, debt increased by 54. Debt increased. We issued debt. لأنه في cash positive in. The liabilities went up, the cash went up. You issue debt. Exactly, you get the cash and you have a debt on your balance sheet that increased. So these are cash from financing activities. We started the year having 60,000. We ended the year with a delta of 20, so we added 20K and we ended the year with 80K. We started at 60, we ended at 80. What was where did the money come from mostly? The cash? From the debt issuance. If we didn't have this, we would have had a negative. دينت مصاري. لما تدينت صار عندي liabilities على البالانس شيت. So إذا بطلع بالترانزاكشن accounting wise, debt went up, so liabilities went up and cash went up, so but the balance sheet balances. Okay, same amount. So if I did not raise debt, I would have had a cash gap, right? A negative here. So I had to issue debt in order to have cash. You were minus 4 and then minus 30. And then you started the year with 60, sorry, yes, you had 60 already. But this 54 is the one that gave you this cash buffer that you have at the end of the year. Sorry, thank you.
Which statement is more reflective of the institution's financial health إذا بدك؟ لأنه مثلاً هون في debt أكتر so مأثر أكتر على الانكم ستيتمنت يعني إذا عندك debt أكتر يعني actually you're not maybe إنه في عندك ما بعرف somewhere هيدا ولا الكاش فلو بيورجي أكتر.
The three of them.
The three of them
the
together.
The three are من هيك they exist the three of them. The balance sheet is showing you a position.
Okay.
وهلا I'll show you what. So the balance sheet will tell you what the size of the organization is, how leveraged it is, between debt and equity. It will tell you how liquid it is between the chunk of assets that are current assets that are easily converted into cash and those that are sitting, the bulky ones that are sitting on the balance sheet. The income statement will show you how profitable you are and how efficient you are. The cash flow statement will show you if you have cash to pay your salaries at the end of the month or not. So every one of those financial statements is giving you one piece of information. You need to look at them all together, the three of them, to be able to understand how the company is doing and how profitable, how efficient, how liquid, and how sustainable it is. Okay? Let's do some questions. So, which statement says what? Which is the statement that is telling you how large the company is? Balance sheet, income statement, or cash flow? Balance sheet. Which one is telling you how large the firm's operations were? Income statement, from the level, from the amount of revenues that you generated in terms of operations. The scale of operations, how much you're selling. So revenues. Which one shows you how leveraged the firm is? Balance sheet, because you will see liabilities versus equity. Which one will show you what happened in the cash account? How profitable the firm's operations were? Is the company retaining earnings, investing in the company, or distributing into them in dividends?
The balance sheet will show you how
Who said income statement? Why?
Because that will show the retaining earnings and we'll see dividends were paid.
The income statement does not show you this. So the income statement will show you the profit that you're generating during this period. The retained earnings, you will see them in the balance sheet and in the cash flow statement. Which one is telling you from the balance sheet and cash flow statement, which one is telling you whether you're investing, whether you're leaving the retained earnings or you're distributing dividends?
The balance sheet is going to show you how much you've accumulated and whether you're giving back to capital. If capital is negative, it means you're not giving back dividends. So it's probably you're just keeping them to reinvest.
Okay. It's both. It's the cash flow statement and the balance sheet. The balance sheet, if you compare 1 year to the other. So if you look only at the balance sheet of this year, you will not understand whether the company is distributing dividends or not. So the answer to this question is actually the cash flow. Unless you have two balance sheets, so 2 years that you're comparing, and you see that the retained earnings balance is going down, which meant that you're distributed dividends, and this is why you would know that it's not investing in the company. So the answer is the cash flow statement, okay, or a comparison between two balance sheets. Which statement tells you how much cash is actually coming in? How does it fund the stuff it owns? Elaborate. How does it show you this?
In the liability section, you'll see whether we choose equity or debt.
Exactly. So you will see whether it's more debt or equity to fund the asset side. What kind of returns are we getting? Which statement? Income statement. The returns, the profitability, the returns that you're making. How sustainable is the firm's structure? Sustainable means that it will be profitable. Income statement. Where was the firm spending cash, investment in capex, suppliers, working capital, OPEX? Cash. Where is it spending cash? So if it's investment in capex, you will see it under investing activities. If it's suppliers and working capital, you will see it under under operating activities, working capital changes. If it's OPEX, you will find it under the net income. So operating activities, the net income would have reflected this. So cash flow. How efficient are the firm's operations? Okay. I thought it was the same question. It's close to versus profitable. Exactly.
So it's how much you're keeping.
Exactly. Another series of questions, and then we break for 5 minutes. You're okay? Yeah. So assume a company has a $350 credit, not cash, sale. How would the transaction appear? You're able to read? Well, I read it for you. So $350 would show up on the balance sheet as a sale. $350 would show up on the income statement as a sale, on the statement of cash flows as cash inflow, or the transaction will not be reported because the cash was not exchanged.
So it's credit as in like
appear in what?
they haven't spent it.
Receivables. No, sale as credit, so مش cash. Credit sale, مش credit. Credit sale.
So it's
So-
receivable.
Receivable.
It would show on the balance sheet on the balance sheet.
It's the
It's
income
the,
statement.
it's an on the income statement. It will never appear on the balance sheet because it's a flow. It will not appear on the cash flow statement because it's a credit sale. So it will appear on the income statement.
Why won't it appear in the accounts receivable?
Bala. But here, yes, but it will not appear on the balance sheet as a sale. It will appear on the balance sheet as income, accounts receivable and revenues. So it's always a transaction that balances. So the accounts receivable balance on the balance sheet increases, but not as a sale, as an increase in accounts receivable. All of the following, no, but okay, I understand your point. She was saying that it will appear on the balance sheet. So it will not appear, you will not see it on the balance sheet. You will notice that the account on the balance sheet increased. Yes, but you will not see that transaction in it. يعني the accounts receivable will increase. Yes, so the transaction will take twofold. The first one is that the accounts receivable will increase, and on the other side, because it needs to balance, the sales will increase on the income statement. When you make a sale, what happens? How do you record it? The sales, it increases your sales, your revenues. صح? If it was cash, also the cash would increase. But the cash is not here because it's a credit, so the accounts receivable will increase. But from the multiple answers here, it's would it show on the balance sheet as a sale? في sale على البالانس sheet? No, it will show as an increase in accounts receivables. Okay, then this is the point that she clarified. بس مش as a sale. Okay, بتبين as a sale بالincome statement. Okay. So next, all of the following increase owners' equity except for which one? Gains, investments by owners, revenues, or acquisitions of assets. Gains will increase owners' equity?
Yeah.
Yes. Investment by owners? Yes. Revenues? Yes.
The exception is acquisition.
Acquisition of assets by incurring liabilities. اللي بيصير هون ال asset side will increase and the liability side will increase. Equity is not moving. Okay, so it's D. Clear? Yes? The accounting equation is expressed as A, B, C, or D. عم نزهقك يلا شوي بنروح على الفاينانشال موديل. Okay, so it's D. Assets is equal to liabilities plus equity. Okay? Which financial statement shows the financial position of the company? The position. Position. Balance sheet. Okay? So the correct components of the income statements are which one? It's A. The balance sheet lists which one of the following? Which of the following decreases owner's equity? B. قلت B أو D؟
لا
B. Which financial statement shows the financial position of the company؟ هيدا من عاد السؤال. Okay. هلا cash flow. What is the impact of the following on the company's cash flow? Increase in receivables. No, it's not a yes or no. كل واحدة منهم بس قولوا لي شو الامباكت. So what is the impact of an increase in receivables on the company's cash flow? It's an outflow. ليه؟ لأنه زادوا receivables ما اجاك كاش. Okay. Increase in inventory. Outflow.
But yeah, I have a question. Is the increase in receivables, is that there is no exchange of cash yet? Does it appear on the cash flow?
Which one?
The increase in the receivables.
ايه إذا شو؟
So I have an item. It's
Yes.
not cash.
Yes.
I sell it, but I still haven't gotten
Yes.
anything.
It's an indirect outflow. It's not ما ظهر كاش بس أثر لك على الكاش بوزيشن ما فات كاش. So كان لازم يفوت كاش وما فات. So this is why we say it's an outflow. You're right. Yes.
So if I want to know how much cash I have to, the item that I sold, I could have sold to someone else for cash. If
Yes.
I sold it not for cash.
إذا بدك it's the opportunity cost of cash. إذا بدك it's the fact that no cash inflow came بنسميها cash outflow. Okay. So yes. You're selling your artisan du Liban stuff to a corporate, and the corporate did not pay you cash. They will pay you in 30 days. So you made a sale on that, which we call on credit. Yes. So when you increase your inventory, what happens?
You pay money to get the assets.
Yes, but you might have not paid cash to your suppliers. So هون we need to, it could be both. Either no change in cash because the change in inventory was mirrored by an increase in payables, or increase in inventory and decrease in cash. Okay? Decrease in accounts payable, I paid my suppliers. So the accounts payable decreased. I paid my suppliers. خف الكاش cash outflow. Increase in sales on credit.
On credit تمام. The same like above. On credit I pay receivable.
It's the same as
receivable. مش ما لها فرق. هي sales on credit و receivables نفس الشيء. Okay. لأنه when you sell on credit your accounts receivable will increase. Collections of receivables. Cash in. Decrease in inventory. Unless بعتي on credit. Exactly. No قصدي so هيدا مثل هون decrease in inventory يا أنت بعتي for cash you either sold for cash so you have a cash inflow or you sold on with credit terms so you don't have any cash. لا في 90 days في 150 days it depends on the sector. It depends on the sector.
وبعدين the cash flow can be done on a monthly basis, not necessarily on annual.
Sure they will but today what happens is this. Increase in accounts payable, good or bad for your cash? Accounts payable, it's good for your cash. You didn't pay cash for the supplier, you increased your accounts payable. Thank you. Indicate how the item affects equity, increase, decrease, or no impact. Expenses,
decrease.
assets, gains, liabilities, no. Dividends, decrease.
Oh wait, no, it's a decrease. It's not in the
حسب ما we need to understand why بس it's asset equal liabilities plus equity. Okay? إذا liabilities نزلوا
to balance.
كيف نزلوا liabilities? So خلينا let's take an example. Liabilities decreased because we paid back debt. So what happened? The cash decreased. So the assets were affected. And the last one is dividends. There you go. Oh. True or false? Last example, last question. The income statement shows the flow of resources over time. True. The balance sheet shows a snapshot of the company's financial position during the year. During the year. So, true or false? False. The cash flow statement should balance. Mean should balance. Which statement? Balance sheet should balance. EBITDA is greater than gross margin.
Gross margin is a margin.
Gross margins is sales minus cost of goods sold. EBITDA is that minus OPEX.
Do we mean the actual?
Gross margin is equal to revenues minus OPEX. Revenues minus what? COGS. We're going too fast? You're okay? Okay. OPEX include the cost of goods sold. Investment in CAPEX is reflected in the income statement.
Should, yes.
How?
Income statement. So I'm paying, let's say in cash.
You're buying a truck.
Yeah.
And depreciation.
But the investment itself, where is it? Where is it reflected? Balance sheet and
It's a VP, it's an item.
it's investing activities in the cash flow. So it's reflected in the balance sheet under property, plant and equipment, and it's reflected on the cash flow statement as investing activities. So you had a question? Okay. So it's not reflected in the income statement, it's reflected on the balance sheet and the cash flow statement.
There is no acquisition of assets in the income statement.
No, it will show under assets. So an income statement is really the actual operations, income and expenses. بلا بس هون السؤال هو sale وين investment in. The actual investment, no, it's not. The depreciation, of course, is in the income statement. Depreciation is a cash expense. Interest expense is reflected in EBITDA. It's earnings before interest, tax, depreciation, so it's before that. Sale of machinery is reflected in the balance sheet and cash flow statement.
Cash flow, yes.
But it stops becoming an asset.
مظبوط.
The sale of machinery is a side that is another power in cash, not in cash.
Receivable.
إذا ما دفعوا لنا إذا أنا بعت ماشين لحدا بس دفع لي هلا كيف بده يكون موجود؟
It will affect the cash flow statement if you paid in cash. If not, it will reflect only on the balance sheet. بدل cash و PPE و accounts receivable. Okay. Let's take a 5 minutes break and we move to ratios. Okay, so we covered the basics of financial statements. We will cover still the financial ratios, the key ones. We will not go through all of them before we move to financial modeling. So financial ratios are ratios that we calculate based on the three financial statements. Some of them will show profitability, other will show activity and efficiencies, other will show the liquidity situation, other will show gearing, which is the leverage, how leveraged are you versus how much equity you have. And some of them are interesting from an investor point of view in terms of return on investment and return on equity. The ones that I would like to cover with you, we already showed. So the net profit margin is the net income, the bottom line, divided by sales. The gross profit margin is the very first level, which is sales minus cost of goods sold is equal to gross profit. So divided by sales is the gross profit margin. We look at these two very closely to see how profitable is the business model, how much it makes sense. is it making money? Is it sustainable as a business model? The other set of ratios that are activity ratios are the ones that are affecting your working capital. You remember when we looked at the cash flow statement, we said that it is impacted by working capital, by changes in working capital. So here we look at the number of days. So we call them DSO, DIO, and DPO. Days sales outstanding, which means the number of days that you give your clients for them to come and pay for the service or product that you delivered. DIO, the number of days it takes for the inventory, for the stock to roll over. And DPO, the number of days that your suppliers have granted you before you can pay them back for the supplies that you purchased. Okay, so DPO, DIO, and DSO. This is a number of days. And why is it important? Because it will affect your cash flow. So we typically look at the working capital cycle or cash conversion cycle, and this is days receivables plus days inventory outstanding minus days payable, and it will you will see how much time you have on your hand for cash. We'll take a case study and see the impact of that on the cash flow. So this is the income statement of a company. This is the actual for Q1, and then this is the forecast for Q2, Q3, and Q4. Okay. What happens is that unlike what was projected, what will happen is a market disruption that will lead to a drop in revenue. So while they have sold 100K in Q1, look how the revenues will drop in Q2, Q3, and Q4. Okay. Now I look at the net profit. They had generated gains of 11K. Here they're incurring losses. Net income is negative, minus 1,000, minus 10,000, minus 18,000. And as a result, the cash position that they have, the net operating cash flow, they started with an imbalance of 11K. They're ending with a balance negative 18. Okay, and the question is, what happened? Why did they get hit that bad from the drop in revenues?
They still have to pay the salaries and everything that was that they have to pay the costs that were not related to the sale of goods.
Exactly. So they have a fixed operating expense structure. So even though the sales dropped from 100K to 21K, they still had to pay operating expenses of 27,000 every quarter. Okay, so the problem is the operating cost structure that is fixed, that is not variable. So what's your recommendation if you were sitting on their board or if you were an advisor of this company? What would you recommend in order for them to improve their position?
15,000 of these from salaries. I would try and see if we can two-timers to provide external advisors that we pay on a bigger basis.
Yes,
So I would try to مثلا if I have many full-timers doing things هون drivers عم تقولي مثلا if I can change the structure of drivers to be paid per توصيلة يعني per delivery أو هيك.
Variable versus fixed. So instead of paying a fixed salary every month, I pay based on the sales. I link it to the sales or
the non-key salaries I can change مثلا to advisor بدل full timer أو consultant أو هيك شيء. So I don't have fixed salaries.
And what can you do to link them to revenues?
Link them to revenues. So
instead of getting your $10,000 salary at the end of the month, you'd only get exactly. So commission based. So instead of getting a fixed salary, you get part of it which is fixed. So let's say your salary is 2,000, you get 1,000 fixed, and the other 1,000 you get as a as a commission on the sales that you have generated, the توصيلة that you have done as a driver, or the business development that you have attracted to the company. Okay, so moving from fixed to variable. And once you have this gap, what can you do to bridge it? You have a cash flow negative. So you need to raise funds, exactly. So the corrective measures are revising the OPEX and linking costs to revenues by altering the cost structure from fixed to variable, and you gave excellent examples, and raising funds to cover for the subsequent operations, okay? Either investors, so founders, or debt. The same example, now what happens is that the revenues do not drop. The revenues increase, but very fast. What happens? What's the problem? So in terms of profitability, you're doing well, huh? 11K, 15K, 27K, 53K. But it's normal, huh? Because look at the revenues, how much is ramping up. So if I look at the bottom line, in terms of net profit, they're doing well. They're profitable. What's hitting their cash position? Capital, which is affecting. So from an income statement point of view, they're doing very well. They're efficient. They're ramped up sales. They're scaling, and they're making profits. From a cash flow point of view, it's hurting them. They're not. Look, they're selling 300K. They're getting a cash balance of 5K. Why? This is eating up their cash. What is this? This is the change in working capital. How do you explain it? What's happening? They're selling on credit. Exactly, and they're paying their suppliers in cash. So they're paying their suppliers in cash. They're selling a lot on credit. They're probably investing in inventory also that they're paying cash for. So it's the change in working capital is hurting their cash flow position. What's your recommendation?
Try to collect the receivables.
Okay.
And
so negotiate payment terms with your suppliers, collect the receivables that you already have, and revise the credit terms that you give. Okay, and then what do you do here also to bridge it? You obtain working capital facilities from banks. So usually when you take an overdraft from a bank, it's precisely to bridge the gap that you have from working capital, because your suppliers are not giving you the terms that you need, and because you need to give clients. There you go. So voila. So revising payment terms with customers, so to shorten the ones with clients and to prolong the ones with suppliers. Revising the procurement strategy is another way of, instead of stocking up on your inventory, do it more slowly. So maybe just in time. So you know that you have an order of olive oil that's coming up. You produce to match it instead of having cash tied up in your stock, and working capital facilities from banks.
Do banks give favorable loans for working capital as opposed to expansion? Or is it like a credit line? They take it very
Now they're not doing anything. But if you have good, you can. There are many ways to work with banks on this. You can either factor your receivables. So you would give them your receivables, and they will collect them from your clients, and you take the cash now. They take a cut. You can ask for working capital as a line. So I need an overdraft of 50K, which I will withdraw and pay back. Withdraw and pay back. It will give me this time that usually is tying my hands between the time I get paid by my clients and I need to pay my suppliers.
And they consider it low risk.
It's
Less risk than funding.
the amount is even the amount is even as typically lower than for expansion. But for expansion, they would usually take collateral For this one, they might not take. So if you were to buy a machine, they would like to have the ownership or a pledge on the machine. If you're expanding, they would, so for bigger amounts, they would require a collateral. For those ones, it's part of the business, and they're small amounts, and it's coming in and out. So it's not a big balance that is accumulating, because usually in these overdrafts, you withdraw and then you pay back لما تجي تدفع. Okay, is it clear? Okay, so the idea behind these case studies is to say that for you to manage your cash inflow and outflow, you need to accelerate receivables. So collect. How do you collect receivables? So you have receivables, a client 30 days, 40 days, 50 days now has not paid. What do? You call them. What else? Exactly. So you provide them discount, or you provide your sales force or your team. You provide them with incentives. Get me this 10K receivables from client X and take 2% of it as addition to your salary. So discounts and incentives. Optimizing inventory. So one example is the just-in-time. So when I get an order, I start the production process in order not to have stock accumulated. It depends on the sector and if it's feasible or not. But maintaining optimal inventory levels to reduce the amount of cash that is tied up. Adopting a credit and collection policy. So as a policy, as a company policy, I do not extend credit for customers that are buying less than a certain amount. For those big customers, I am willing to give 90 days, but not more. Okay, so these sorts of payments terms are included in the policy, and you should have, once you are selling on credit, you should have a credit policy for the sales force to abide by, and then in the sales and the credit policy, you will have also how you will manage. So in terms of aging, when do you take provisions on the aged receivables, when do you collect, when do you write off, and so on. How to manage the outflow, so the other side. Prioritizing payments. So you have payment dues to your suppliers, but also to your staff. So you need to know what is essential for me to pay now, because it will affect directly the cash flow. If the supplier can wait until next month, let me pay my salaries this month, and the supplier can wait. So this sort of prioritization. Negotiating payment terms with suppliers, and monitoring capital expenditures. Also, we evaluate. So there are 3 projects I want to work on. This is the capital required for each. I need to prioritize. Okay. And so this is the cash flow drivers. So the cost structure will. So make sure that you monitor your cost structure in terms of variable, fixed, outsourced, insourced, to be able to monitor your cash flow. On the payment terms, and the financing mix, to make sure that the financing costs are not also absorbing your all your profits. So here is the interest expense, right? So make sure that you are not too levered, you don't have too much debt, that the interest expense on this debt, especially in today's environment where the interest rates are very high, make sure the interest rates are not eating up all your margins. So know where to stop asking for that, and maybe opening your capital structure for an equity issue or for a safe note, like we explained last time. I'll show an example that we will look at together, and then I'll move to the financial model. Just one last view on financial ratios, because these are the important ones that you will manage your company based on going forward. So what are we seeing here? We're looking at liquidity measures. So here we usually look at, you can see from, okay. So these are the liquidity measures, current ratios, which is current assets over current liabilities, to indicate how much liquid assets do you have versus the liabilities that you need to pay immediately. Okay, these are the cash conversion ratios in number of days. So let's look at this one. This is a cash conversion cycle here. of 246 in December that moved up 329, 202, 179, 155. And this is the result of a combination of inventory days, receivables, and payables. So what observation can we make on the evolution of this company? In terms of inventory, let's take the inventory. In terms of managing their inventory, how have they done?
The rate of inventory turnover.
Okay.
They're probably maybe not stocking up as much. Maybe they started using it in time, just in time.
مظبوط. Although they took a hit here. So here in 20 and 21, it was a bad year for their inventory management. They were taking too long to roll over this stock, and then they improved on it here, in line with the benchmark. On the receivable side,
They also decreased their receivables, at least in the last year.
okay, exactly. So if we take 2022 and 2023, they improved a lot on inventory management and on receivables collection or the credit policy that they have. What about their suppliers?
They also got favorable
لا ما مش favorable.
payables turnover rate. Let me increase and then so
عم بحكي 2022 2023.
is they have to pay quicker.
Quicker, exactly. So this would hurt them, and they're paying in 119 days while the benchmark is 135. So the suppliers are putting pressure on them, and the result, however, is a shorter cash conversion cycle, right? Because it was at 202, because they benefited from the better management of their inventory and receivables, although they got a hit here. But overall, they slightly improved their receivables, their cash conversion cycle. Okay, so in terms of cash flow, are they better off in 2023 or in 2022? بدنا اياه اطول او اقصر؟ كل ما عم ياخذ وقت to collect. بال 2023 احسن. It's a shorter cash conversion cycle, so I'm converting my cash more rapidly. Okay, so I want a cash conversion cycle that is not too low. I want a fair treatment between my clients and my suppliers. So I'm giving 180 days for my clients, but my suppliers are not giving me 180 days. They're giving me only 120. So I need to negotiate with my suppliers in order to get better terms, especially that the receivables are in line with the benchmark, with the industry. So it's normal, it's industry practice to have 180 days in receivables, but for the suppliers, I can still negotiate my terms here. Okay? لا عم بحكي 195 versus 119. ايه I'm saying go ahead. Yes.
I'm giving 170 days and I'm taking 190.
119.
190 and giving 170.
Sorry, yes, معك حق عم بطلع على الفوق. Yes, so okay, I misread. So the receivables and payables are in tandem, so it's, I see your points, I'm sorry. So 117, 119, it's fair. So what I need to, in terms of receivables, payables, it's fine, but in terms of industry benchmark, there's room for improvement on the payables one. مظبوط?
How do you calculate the financing gap? Do you use the three numbers before it?
This plus this minus this. مظبوط؟
I think so. So 290 minus 135, yes.
181 plus 117 minus 119. Okay. Another set of ratios, these are the solvency ones. So debt to EBITDA, debt to net profit, to see how levered are you versus the level of operations you have. This is in terms of profitability. So what we look at is the growth in sales. How much are you growing? How much are you scaling? The gross profit margin, net profit margin, operating margin or EBITDA, and return on invested capital. And here debt to equity and total debt ratio. Okay, I will not spend more time, but to give more time for the financial modeling part. Any questions so far on financial management, on financial ratios? Is it clear? Okay. So we reached the step on financial modeling. So in order to build the financial model, you need to have done all the transformation plan اللي حكينا عنها. So we need to understand first of all what is the value proposition that you have. What are the revenue streams that you have? You need to be able to list them like this. Not today, not the current revenue streams, but those also going forward. You need to understand how your cost structure looks like. You need to understand what are the growth opportunities that you are engaging in that will reflect on your income statement as additional revenue streams, but will also reflect on your balance sheet and cash flow statement, because you will need to put in money, you need to invest in machines, and business development to acquire new markets, to do market. So there is money that needs to be spent, and this money we need to see how to allocate it in the financial model. So you need to do this reflection before going into your Excel sheet and starting to build the model template. So have all the answers beforehand in terms of revenues, in terms of expenses, OPEX and CAPEX. See how your days inventory, days receivables, days payables are going forward, because this will affect your cash flow. What kind of investments do you need to do? And based on this, the final result of the financial model is for you to identify what is the financial gap that you have, what is the funding gap that you will have to go to investors to raise money, to raise debt, equity, safe, grants, etc. Okay, so how do we start? There are many assumptions that we need to look at, and all of them will come from the transformation plan. So projection of sales in terms of what are the revenue streams and how much are we expecting from each revenue stream. The projection of costs, also what are those costs, the incremental ones that are coming as a result of the new businesses that you will be introducing as well. The working capital assumptions, DSO, DPO, DIO, we just covered, and the investments in terms of CAPEX that you will have, okay? And this will be a resulting factor. So the financing assumptions, we will put them at the end, before the financial model is done, but at the end of it. So the last step would be, okay, we did the model, we identified the gap can be filled either through debt or equity. We decide based on the financial model, and then we plug in either a debt with a corresponding interest payments and interest expense, or an equity with a corresponding valuation and cash implication.
Sorry, I'm going to ask a basic question. Sorry إذا عم ضيع وقت.
أبداً, you're not. We're all benefiting. We agree.
Okay. بالنسبة للprojection of revenues, هلا I think I know the answer شوي, but I want to make sure that it's correct. I know how to project cost because I know the cost of my supplies. But revenues is more difficult to project. I have a history. I can base myself on the history. بس مثلا نحن in our case specifically, the situation in Lebanon, in Gaza, in هيك will considerably affect this projection. So شو البنشمارك to project, and how do you account for this risk you have? يمكن بيكون أنا براسي logically لازم يكون عندك شيء اسمه contingency أو شيء هيك, بس I'm not sure إذا أنا صح ولا لا. بس I want to ask this question, please.
No, it's absolutely zero. Thank you very much for the question. It's very important. What we typically do is we run a base case scenario. So in case things go as planned, without any surprises, without any incidents, this is what I expect in terms of number of customers that will come, how much they will spend, how many projects I will take, how many courses I will deliver, how many customers will come to my boutique and buy my stuff. So this is my base case scenario. At the end of it, we ask for another version of this scenario, which we will call the worst case. The worst case, if things do not go as planned, and then instead of having a growth rate in sales of 10% year on year, I have a -2. Okay, so I run my business, my worst case scenario, and based on the worst case scenarios, exactly 2 pages, 2 versions, based on the worst case scenarios, what are the mitigation actions that I can take in case it happens?
Okay,
And this is where we go back to the variable versus fixed cost structure, insourcing versus outsourcing. So if I need someone, I call them in and they come. If not, I will not have to pay their salaries. So this is how you make your cost structure more flexible to accommodate for those changes.
عظيم. هلا نحن we are introducing a completely new kind of activity اللي هي we're giving out certificates as of this year.
Yes.
We're launching in soon, very soon. How do we project based on something that we don't have? يعني ما عندنا benchmark من قبل، ما بنقدر نعرف 100% غيرنا قد ايه عم ببيع for sure. في ناس عندهم بس نحن بمحل
قد ايه يعني quantity ولا البرايسنج عم تسألي؟
لا الكوانتيتي يعني الريفينيو.
How many people will come؟
ايه how many people will come. انا بعرف الجامعات بيحطوا عندهم قد ايه هن بفوتوا so I can see. بس انا ماني جامعه كمان بعرف يمكن الورك شوبس الصغار ما بقدر اعرف. انا بمحل in between ما كثير عندي بنش مارك اقدر to base myself on في study عنها او شيء هيك. How do I calculate بهالحاله الريفينيوز؟
Thank you. Again, a very, very important question. We will cover it now, but to answer shortly, you need to understand, if we go back to the discussion we had on Friday, you need to understand your market. So for this, now you're looking at a new market. Let's say it's a different focus. So you need to do the market study to understand the size of the market. You remember سميناهم TAM, SAM. So the total addressable market in Lebanon, how many students or potential students can exist? And then the SAM is the serviceable market, which is your concentration. So how many students are interested in the product offering or topics that you are giving? And from this sample, what market share are you targeting? So I want from this market, I did my analysis, this is the full market, this is the one that is interested in my products, and for this one, I'm looking to acquire a 20% market share. Yes, this is how she can identify what is the target market that she's looking at. So this is how she can size the market. By doing surveys, by doing focus groups to understand what people need, how many people are in this age bracket, in this I don't know, sector. So to understand how big is the market. And then your decision is to say, I'm interested or I'm aiming to get X% of the market. Another way of doing it is bottom up. So this is top down. This is the market. I want to have this part in it. The bottom up approach is by saying, from my network, I estimate that I will be able to attract during the first month 30 candidates. And 30 candidates will, the pricing will be X, so my revenues are 30X. And next month, I have recurrent students. So you see how many are recurrent versus how many are leaving. And from those, they will be able to refer other people. And this is how you put your assumption. So let's jump directly to the model, to the example. So this is, depending on the business model that you have, you will have different revenue streams and different revenue modeling. So we're taking this one, let's start with this one. Is it too small? عم تقدروا تشوفوا؟ كريم فينا نعمل لها زوم شوي لهيدا؟ بهيدا صح؟ بليز. نو واي ما بتقشعر شي هون. كان لازم تقوله.
هلا انا مع العمومي هلا احلى شوي.
اوكي ثانك يو. بس ما في زيحة شمال ويمين. اوكي. So this is one example. So if I'm looking at a business model where I have a membership revenue, okay? So I estimate how many clients will I have. I'm doing this for the first year. So every month during the first year, how many clients do I have? And the way you go up from 50 to 100 is an estimation of the referrals and dropouts and additional acquired clients. And this is the membership per client, so this is my revenue stream. In order to get these numbers, there's another calculation that you need to do. So here I'm only jumping to, I know what is the number of customers that I will have in this, but for you to get the 50, you will need to do the study on your existing pool, on competitors, what do they have, on the market size itself, for you to say, yes, I am confident that I can get 50 clients during the first month and convert these 50 into 100 the next month. Okay, and this is an example where our revenues is relying on memberships. The second example is commission based. So I'm selling products. I expect X number of clients. Every client will have 2 baskets. So they either will come twice per month or they will make 2 purchases. So 2 times. The average basket size is around $5. So every time they go to Artisan du Liban, they spend $5. They come twice a month, and I expect 50 customers. Okay, and the commission I'm taking on the sale is 20%. So I'm not getting 50 times 2 times 5. I'm getting 20% of this, which is the revenues of $100 for me per month. And again, you need to do the reflection, first of all, on the dynamics of the average basket size, so the dynamics of spending, how they evolve, and how you will incentivize your clients to spend even more, the number of times that they will come to you, and the number of clients that you will have. So each of those, there's a work to be done for you to reach to these numbers. And the first one here is either when you have, just like in your example, you have different products, so product X, product Y, product Z, each of them is priced differently. So I expect to sell 10 pieces of product 10 at 10,000, or have 10 projects, small projects of 10,000 and have 1 large project of 100,000. So it depends on the revenue, on the business model. Is it projects, is it products? And you model it this way. So this is for the revenue, and it's very case by case. So this is why we suggested to have the focus sessions that we're holding next week and the week after, for you to tell us what is your business model, for us to be able to help you on how to model it and how to build the financial model template that you have. Okay. So for now, this is a menu, and we will see which is more suitable for your business model based on it. So here what we've done is we did the projections for monthly for the first year. After the first year, how do we do it? We can either continue doing it like this, but it's less and less, not accurate, but difficult to forecast monthly how it's going to be looking later on. We can do it like this if you have the information, but we can also agree on growth rates. Okay, so you can see with this zoom. Okay, so I'm saying that my growth in revenues for that first year I'm doubling. In 2026 I'm increasing by 50% for product X. I'm increasing my revenues by 30% and 20% for product Y and Z. Okay, so you do it monthly for the first year. If you want to do it for the second year monthly and aggregate, you can do it. Otherwise, we agree together on a growth assumption. We always need to check if it makes sense or not. So we look back at the market size and we say, okay, with a 30% increase in revenues from product Y, what is the percentage of the market that I'm covering? If I'm already at 100%, doesn't make sense. If I'm ramping up my presence in the market from 5, 10, 20, 30, it makes sense. So it's always a bottom up and a top down to reconcile and make sense of the numbers. Now, the second line on the income statement was the cost of goods sold. So for us to do this, we need a percentage. And this you will know from your business. You have the historical financials, so you know already that for revenue stream 1, the cost of goods sold is 30%. But you know that there are room for improvement on it because you can improve on efficiency and reduce the margin that you have, increase the margin that you have from 70%, so reduce this from 30% to 20%. So have a margin increasing from 70% to 80%. This is something that you project because you know that as you're ramping up, you have economies of scale and you can manage to improve the processes and reduce your cost of goods sold. For product Z, I'm maintaining a 5% cost of goods sold. Where did I get the 5% from? From my actual experience today. So if I'm just starting to go into business, I need to have this one product that I'm doing. قد ايه كلفناه? How much did it cost? How much am I selling it for? And what is the cost of goods sold? Okay. And again, it's case by case. So we need to see the business model. We need to agree. If I take the fertilizers, she knows already today what is the cost of one bottle of fertilizer. This is her knowledge of the business. For l'artisan du Liban, working with those ladies, you know how much they need more, they need less, and so on. You can quantify. Okay. It's a lot of historical experience. It's a lot of asking around if you're entering the market anew, and it's a lot of validating with market research, with your advisors also if it makes sense or not. So once we did the forecasting of revenues and the cost of goods sold, this is what we have. Okay, we have the net sales by product line, the cost of goods sold, and the net margin, the gross margin. So here I have a gross margin of 82% because my cost of goods sold is only 18%, and my sales of 1.7 are mostly coming from product X and Z, or line 1 and 3, and 17% is coming from line 2. Questions? نعليه مسقعة؟ قويتلك اياه انا. اوكي طفيت واحد والثاني خففته. Natalie, you had a question here.
تقريبا ضاربين بستة يعني.
Voilà. But it's a random example. It does not compare to your business model. Yes. 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 So the pricing maybe needs to be exactly. So this is going back to the discussion of that your consultant was telling you about. And she's saying gross margin one does not make sense. So she needs to work on a higher gross margin. How does she do it? Her cost of goods sold are fixed. So she needs to review the pricing. The cost of goods sold كمان? Okay.
What they used to do before is buy raw material and then decide which product to do. هلا Yeah, it's really week per week. When we create a product, we buy just the right amount of material for this product. يعني ما
Yes.
عندنا excess inventory بالraw
Voilà.
material.
Okay.
This is how we reduced. And again, seeing other suppliers, competition, negotiating, that we reduced COGS by
And did you
almost
change the
50%.
pricing or you maintain the pricing?
This is one of the great big challenges of Artisan Liban was the pricing strategy. هلا نحن we have very low prices يعني very sorry المارك اب تبعنا صراحة 1.3. This is not a markup
Okay.
يعني 1.3 يعني
Nothing.
just to know 1.4 يعني it doesn't cover at all the operating expenses because we are a social enterprise and because our aim is to really generate income for artisans. We work with around 1,000 artisans a year. Our mission is to have the maximum artisans possible working with us. So we used to produce products even when we didn't need them, just to generate income for these people. So and the pricing, the idea behind it before was if you price a higher price, you would sell less of this pouch. If you sell less of this pouch, so less women, ladies are working. So يعني ما كنا نغلي كثير الأسعار. Sorry. Okay, this is another issue هلا. This is expert حسب وين وكيف يعني online, B2B, corporate. I mean لا أكيد we've been here for 45 years and this is nothing. هنشوف نحن we are producers, we are buyers, we are sellers, and we are social development projects بنشتغل عليهم يعني we are many هيدا. And we are currently dividing our income statement into these 4 or 5 sectors to see which one is profitable, which not is not, يعني, without forgetting the mission. So for the pricing, what we did, just to answer your question, we cannot come in, ما فينا نقطع من 1.3 على 2 or 3. يعني if you are used to, our clients know our product. If they used to buy it for $10, ما في حتى $30. But then it has to have a perceived value of $30 too, because handmade in Lebanon costs a lot of money comparing to China, to India, to our competitors. It's a whole, what we are doing right now is we are testing the market with higher end product and we are creating product that looks a higher end and different of what we used to have, so people cannot compare in their mind bit by bit
Okay.
point by point.
Okay.
عم بعمل ريبراندنج ريبوزيشننج هذا كمان بده ماركتينج هلا انا بركي عم بعمل شيء جديد ما عندي كليونتيل اللي بتدفع كثير بس انا كيف بدي اجيب هالكليونتيل كيف بدي تعرف انا عندي هالنوع كمان بدك الايمج بدك الفيترين المحلات الماركتينج الانستغرام كله هيدا فيري بيج بادجتس ولا العالم بتدفع $15 حق قهوه صارت كله براند اكيد براند بيرسبشن از everything. Yes. Yes. ما هو شو بيعطي الهاي اند؟ الهاي اند is about the image that you give. It's the product كمان بالمحلات مثل ما قلنا المارك كله هيدا it's very كيف بتجيب العالم اللي بيشتروا عندك؟ قد بده يجوا لعندك؟ ما بروح عند اوريون كات نف مثلا، العباية عنده ب$2000 هي بركي مكلفته $100 بس هو في بيع ب$2000. ليش؟ لأنه اوريون كات نف في وجود، في اسم، في فيترين، في ديكور، وفي برايفت سيكتور وراها، في ريسورسز، في هذا ستايلست. وبعدين اوريون is not saying أنا لبنانيز ارتيزان. لا عم بيجيب من الهند، الهند بيعملوا قصص بتاخذ العقل بفراكشن اوف ذا برايس اللي نحن بنقدر نعمله بلبنان. بس انا سوشيال انتربرايز، هو لا ما سوشيال انتربرايز، انا بدي نفع عالم. شيء قبل نحن ان كومبيتيشن مع البرايفت سيكتور، مع اوريون، مع مفتاح الشرق، مع بوتيك دو موند. انا ماني كومبيتيشن مع حدا عم بيعمل مثلي سوشيال امباكت. انا ما عندي ذات تشالنج، ما بدي انسى السوشيال امباكت تبعي. لا انا اكزاكت، ما هيدا عم نشتغل عليه هلا شوي. اوكي انا I'm selling products at the end of the day. I need clients. I'm diversifying my revenue streams. يعني عم نعمله هلا غير انه عندنا المحلات والاونلاين. We are working on the B2B. يعني ديجا نحن corporate gifting كثير قوي. هلا راحوا لبنوك we are يعني هلا اذا عم نشتغل مع غير clients برات لبنان للcorporate gifting. What I'm doing right now, one of the things that we introduced is B2B business من ناحية انه since we are producers, ليش بس I'm gonna produce for l'artisan du Liban? I'm producing for other brands. انه اخرتها كمان it goes with my mission of انه شكل ارتيزان. انا عندي بول تقريبا 1000 ارتيزان بدهم يشتغلوا. انت عندك ماركه، انا فيني صنع لك، انا عندي بول اوف ارتيزان بيعملوا لك دونك فوالا.
بس في كمان مثلا اليابانيز دياسبورا بالنسبه لك انتوا لانه ليبانيز
مظبوط.
ايوه
مظبوط. those are our clients already. أصلاً ما أنا لا هي المشكلة. أنا I'm only selling to this kind of people. يعني أنا my client كمان أونلاين يعني أكثر مثلاً كندا، أستراليا، هالنوع البري نوستالجيك على الأرز وإنه our clients are هو بالعكس لازم لا لأنه نحن إيه لا عن جد بيحبوا مثلا الشفة الأب عليها أرزة كذا. هو الأكثر نورث أمريكا، أستراليا اللي تركوا من زمان لبنان are very nostalgic. مثلا البلاد العربية سوري حكينا أخذنا كثير وقت.
لا في شغله مشتركه عم فيها وكثير هي النقطه اللي هي كشركات بتشتغل سوشيال امباكت. عندك الكوست اوف جودز بيختلف عن اذا انت عم تشتغل تجاري. يعني انا شركه بصنع فيرتيلايزر ما لا ارتيزانا ولا شيء. عندي الكوست اوف جودز ثابته هذه انا ما بقدر غيرها. يعني بيقولوا لي طيب انت روحي جيبيه من هذاك المطرح. اوكي انا قادره اجيبه من هذاك المطرح بس ما عاد في عندي سوشيال امباكت عم بعمله، ما عاد في عندي الايكونوميك امباكت اللي عم بعمله. فكشركات او كمؤسسات يعني يمكن هذه مشتركه. كيف نحن فينا نكون عم نلعب على البرايس بنفس الوقت في عندنا كوست اوف جود سولد ما بنقدر كثير نوطي لانه السوشيال امباكت اللي عم نعمل. نحن بنصنف كشركات ذات تاثير اجتماعي. فهون في جاب موجوده. ما بعرف اذا في لها حل. هون يمكن صرنا اكثر سيلز، صرنا اكثر ماركتينج but something related pure للفاينانس. لانه انت عم تقولي لنا لا يعني ضبطوا السيلز، ضبطوا البرايس، اشتغلوا على الكوست اوف جودز، اشتغلوا على الاوبكس. but something كله related.
No, absolutely, and this is the challenge of a social enterprise because they need to balance between the impact and the financial profitability and sustainability. But this is why you need to think of new and different revenue streams that might bring you this financial sustainability. So these يعني مثل هون عملت الرنتل. She doesn't own the place, but she rents it, but she sub-rents it for her to have this income to improve the profitability. So the core activity that you do will always be impactful and will always have less financial attractiveness compared to others, but this is how you bring in other growth opportunities and you map those growth opportunities مثل ما شفنا الجمعة to have them. Yes.
الفاريبل كوست انا بدي العب عليه. هون عندك فيكس كوست هي الارتزانات الويتشز طبعا هي مو بس اوكي انا بعتبره كفيكس كوست بالنسبه للكومبيتيشن بس انا كثير العب على الفاريبل كوست تبع على الرنت نزله على البيلدي نزله على القصص او اعمل برودكشن زياده تخفف الفاريبل كوست من
الايكونوميز اوف ايكونوميز.
هو حسب السنه حالتنا الفاريبل كوست اللي نحن بنحكي بتودي زفا من كل كيس بتوزنها. بس هي نقطة مشتركة يعني.
يعني أنا لما صرت عم بنتج أمين زائد بدأ زائد بدأ أمين حقه $. إذا عم تخرج 100 أمين بدأ $100. يعني الكوست تبعي هو زائد. الفاريبل كوست هو اللي عم ينعكس عليه إذا عم تشوف واحد أو عم تكون هذا أصلا
فيك تستعمل الواحد بيقدر يستعمل الامباكت يعمل ماركتينج. يعني هلا اكيد انه الواحد بده يعمل امباكت للامباكت بس بيقدر انه هيدا اللي بفرقك. يعني هيدا اللي بفرقك عن اورينت 499 او عند حدا عم بيجيب برودكتس من الصين هو الامباكت. سو انا بحس انه مثلا لنقول بدل ما انت بس تبيعي لدبي عن طريق انه عندي ويب سايت صرت بقدر بيع لدبي just have a campaign that says give back to Lebanon. أنا ساكنة حد الارتيزانات من أنا وصغيرة. عن جديد لعرفت إنه it's a social enterprise. عن جديد يلا عرفت إنه it's about the artisans. كتير جديد. بفتكر لما عملتوا campaign وقلتوا إنه do you know عملتوا survey وهيك أشياء وكذا. بوقت عرفت كان يعني أنا اللي بشتري من عندكم
يعني يمكن شي 5-6 سنين لورا او هيك شيء. انا ساكنه من هونيك من انا وصغيره وماما وانا وكل لما نسافر بنشتري من عندكم دائما هيك، بس وي نيفر نيو. اوكي وي نيفر نيو انه ايه ايه فانه the brand is known but the impact is not known. ويمكن فيك تستعمل الامباكت على الكامبينز اللي مع برا، لانه هيدا الشيء عم بكلفك مصاري يوزت. نفس الشيء بحس كاربلايزر انه لا بالعكس، لانه فارمر، بالعكس لانه فارمر ومع الازمه الاقتصاديه وكل شيء عم بيصير وباي لوكل وهيك اشياء فيك تستعمل.
So the idea is as much as you're stressing on the impact when you're talking to investors, you need to stress on the impact to attract a niche client base, which is really purchasing, even if they're paying the $2 extra, but they want organic, they want a product that people in the rural areas in Baalbek are working on, women that are, so people want this, people are, yes.
بس انه عملوا كذا حمله توعيه على الموضوع. جبت العالم هلا اليوم دارجه اكثر، اكيد اكثر العالم that are very aware of this يعني. بس it is never enough to make the business sustainable يعني. خاصة عم تبيعي عن برودوي يعني مش اكل مش للصحه يعني اخرتها مثلا اوكي بنجي على الارتيزان بنشتري مره بنشتري مرتين بننفع شوي بس خلص عم بيروحوا غير محل يشتروا شيء احلى.
But exactly, so it's both. Yes.
أنا عندي بيدجي كثير ليميتد يعني أنا ما عندي هالريسورسز وأنا بحطها للماركتينج لأوصل هيدا المسج أو بحطها بالبرودكشن تحسن البرودكت تبعي والانفراستراكشر تبعي. يعني أنا مانيش بيتي ما عندي جراند أو ما عندي انفستمنت أقدر أعمل الاثنين أون باراليل. ده اللي بهتم ده اللي بوصل الخبرية. أنا شو أنا سنة مين الكلاين تبعها بدي مين يكون عند الكلاين؟
ناتاليا English.
established clients تبعنا هن مين expats وtourists يعني أنا اليوم نص من التعليجات.
Did they know about the impact when they bought? Because she's saying
أكيد
Are you sure?
Guys,
no, I'm not sure because I used to be a very good client of Amazon.
معلش بس
The former GM, she explained it to me on live and she always
yes. بس to be conscious لأن عنا a lot of let's take this بالتاني break بالآخر let's stay here and we'll have coffee together and continue. Yes. Yes.
So as a startup or new company,
yes.
البارت تبع DSO اللي هي نحن نعطي for our customers.
Yes.
في كثير pressure يعني علينا because it is mindset
yes.
partner every 3
yes.
months is okay. But for supplier, because we are new, because they don't give us a lot of time. So what is how we can there is some
this is the challenge of a startup because people don't know you enough to give you better terms. This is where you can rely more on different channels. So instead of selling to your farmers directly, seeing if there's a distributor that can do it for you and provide you with lines. So thinking of the delivery channels that might help you manage the working capital cycle, but it is one of the biggest challenges, and this is why. Yes. Yes. Yes.
But what you mentioned there is not for startups.
But entering into partnerships might help you. Entering into distribution agreements might help you. Negotiating with suppliers, coming together with, we need to see it on a case by case. But this is the number one challenge. Why do startups need funding for things like this? To pay for the working capital needs, to pay for the operating expenses that they have, and revenues are not strong enough to cover for them. Before we start looking at expanding to Saudi and to Jordan and so on. So what are the funding needs of a startup? Working capital, OPEX, mostly. So this is the common theme. Let me go faster and then we take questions again. When you're doing the revenue projections, I can put so if I go back to to the slide here, I'm putting that I'm ramping up my sales from 1.7 million to 2.6 million. How do I validate it? How do I show that yes, I can make my 2.58 million? I need a strong sales funnel. What is a sales funnel? And if we take the fertilizers case, you have contacted farmers that they showed interest in your product, and they said, yes, we need an order of 500 bottles in October. You put them here. So your customer names, the description of the project or the products that they're taking from you, the size of the project or order that they have, the estimated time, the probability of success, because it doesn't happen yet. But you know that this one, I'm getting an 80% on it. This one, it's still risky, it's a 30%. And the corresponding probability of success, high, medium, and low. Based on this sales funnel, you will make your sales forecast. So this is a third way of building your revenue projections. What is the sales forecast? It's the product, the multiplication of the project size with the probability of success. Okay, so I have them listed. I know that I have those clients, and based on this study, I know that I'm generating in month 4 24,000. Okay, once I do it, because here I have the timing, so I have for this first year month by month how it looks like. So I know my sales forecast is based on evidence, on discussions that I have with potential buyers, potential clients, and I can validate the numbers that I have put in my financial model. Now, we did this for revenues. What about operating expenses? So the first thing is salaries. So I start by listing the number of staff that I have, and how it's going to ramp up. So I start with one general manager. I start with 2 people responsible for operations, but I will need 4 in year 8 and 2028. A customer support agent. So you list all your organization structure, okay? For each of them, how many people you need, and for each of those titles or position, what is the average salary that they're getting, and how this average salary will increase. So for the general manager, because we're still starting the company where we're at the beginning, I will not take a big salary. I will only take 1,500, but in 2 years down the line, I have validated my product, my business model. I can afford to take a bigger salary, so I increase my salary. So you either do it based on inflation, so here 500, 550, and 530, so I'm only increasing with the growth rate and inflation, or I decide that I will give myself a big raise here, I will give my business development a bigger amount here, and so on. Okay, so this is how you project your salaries, which are the biggest part of your OPEX, and then what are your other monthly costs. So here we list them. So marketing, advertising, insurance, utilities, legal, promotions, and so on. And usually we add an OPEX buffer. We say we will add a 1% or 0.5% buffer for the OPEX that I don't know of today, that I cannot put, but to have this buffer. And then rent. Okay, these are monthly. I put them here because it's more intuitive to look at those expenses on a monthly basis, and then the model will annualize them for me. So this is how I would project my operating expenses.
You had a commission for the salespeople. Where did you put it? In the monthly costs?
الكوميشن بالكوجز.
Commission costs?
as well as sales. As a sales related COGS. Okay. So here you would put the salary of the salesperson, but any commission that they're getting, بتحطها percent, you're giving them 1% on their sales, بتزيد على cost of goods sold.
Sorry, how do we estimate probability of success? Do we have?
Because you talk, so you are organizing a workshop next month, and you already started talking to people, and you know that this one is just coming to pay. يعني هيدا 90% جاية، هيدا بعده عم فكر. They're still not sure. It's an estimation. It's very subjective, but it's based on your discussion with your prospective clients. Okay, clear لهون. So we covered revenues, cost of goods sold, and operating expenses. What are we missing? In terms of projection, what are we missing? Depreciation هلا بنشوف depreciation on what? Okay. No, so capex. So we need to project capex. Okay, so this is how you do it. So here I'm doing it quarterly for the first year and then a year on year later. So I'm expecting to invest in an apartment, refurbishing an apartment or refurbishing the showroom, 5,000. I'm buying machines of 3,000 in Q1 2024, and then I'm investing more in 2025, and I have a big investment in 2026 of 8 million. Here I'm launching a new business line, a new product line, so I'm investing in a large machine. Furniture and equipment, vehicles, I'm buying a car here. Furniture and equipment, every year I'm adding something to my workshop or something to my studio, and I'm acquiring a software, okay, either ERP or an e-commerce where I'm building. So this is intangible fixed asset. So the total amount is 72 spread each quarter in Q2, and then 60,000 maintenance in 25 and 26. So these are capital expenditures, not fixed assets, intangible assets, not tangible, intangible, but that come here. And then those intangible assets will be amortized, going back to Natalie, and those fixed assets will be depreciated. Okay, and the template that I will that the team at Alfanar will be sending you, I will share with you. It has the depreciation amortization table calculated. So all you need to do is plug in the numbers here. Okay, what are your estimated capital expenditures that you have? Clear? Intangibles, yes. Amortization is exactly depreciation, but for intangibles. So software, when you build an e-commerce website, you need to make changes to it. Eventually, it will depreciate. It will not ما بينتزع بس بيصير somewhat obsolete. So this is the. No, it's not fees. It's the fact that it will lose value. A website that you create today will not be as new as it will be in 5 years. So the value of it will, just like the car, when you're using it, the value of it will decrease. No, the London building, sorry. Sorry, I interrupted you. London building is the only one that doesn't get depreciated. And this depreciation and amortization expense will go to the balance sheet income statement or cash flow statement. The depreciation and amortization will go to the income statement as depreciation expense. Okay, and the accumulated year on year will go to the balance sheet under accumulated depreciation.
So the amortization is basically the same assumption as depreciation. It's
yes.
In 4 years, I will have to service it. So I have to calculate it per year so I can account for it and it doesn't surprise me. More or less.
Yes,
so
yes.
Taking it in the calculations, even though
it's the fact that here the idea is you're putting a website on your balance sheet. Okay, اليوم you put it, you go live, and the value of this website for you, because it costs you to build it 10K. Okay, its value will depreciate, will go down. So in 5 years down the line, on the balance sheet, you cannot put 10K. Its value is really not 10K. If you were to sell it in year 5, you will not be able to sell it at 10K. This is the thinking behind it. مثل السيارة. So you purchase it today, model 2024. Today حقها 10K. In 5 years ما بقى حقها 10K.
But it's an asset. We consider it an asset.
It is an asset.
Even though, like, I know.
What is the website?
In you're
It's
gonna
an
sell
intangible
probably
asset.
the domain name probably. That's should be there later. But like everything you put into it, it's just
But it's not an expense, and we capitalize it. What do you mean by this? It's not an expense. It's not something that you incurred وخلاص راحت. It's an asset that you have. You know, مثل لما تقول لي عمرت شلف.
أو عملت براندنج تبع
البراندنج البراندنج شيء ثاني. البراندنج بتروح جودويل بعدين. No, البراندنج it's marketing and advertising expense. It's something that you incur وبيروح. بس when you sell the company, the brand has a value, which is if your company is valued at 10K, 1 million, I'm ready to pay 1.5 million for it. Why? Because it has a brand. And this الفرق بين 1 1.5 is the goodwill.
So there is a way to calculate brand equity.
But upon sale, the goodwill, you don't recognize it before you sell. It's the difference between the book value and the actual price paid for the company.
Sorry, عم تقولي له على الويب سايت شيء هيك شوية يعني you're saying something about the website that's شوية هيك يعني unclear for me. إنه you said that since you paid for it but you're still using it, that the money didn't go away. But you can argue about anything you pay in this sense. So nothing becomes an expense except maybe repairs بهالحالة.
What about your salary?
My salary, I'm using the person. He's here all month.
But no, yes, but all month. He's not here to stay. بعد شهر بيقدم استقالته and he leaves.
Okay.
What? The website you have it.
So the idea is if something lasts,
and
if it's
and
something
you own it. It's the property of the company. You own it.
Okay. So the idea of it being a property. هيدي هي
Yes. We started the definition of asset is something that you own. As a company, it's your property. You own it.
Okay. And hopefully you don't own your employees.
Exactly.
Okay.
You had a comment?
In our case,
Sorry بس لا يطلع الفويس بالريكوردينگ.
In our case, نحن with food site, we don't consider the website as just an asset. We consider it بالcapex لأنه this is our product. We have the web app, so
Yes.
the services that we
Capex
deliver are
is
part of.
It was a capex investment, so you have it as an asset
بس
under your
بهالحالة
balance
في
sheet.
depreciation عليه كمان.
Amortization.
Amortization.
Yes.
But it grows with time, the value of it.
It grows because
Like you're working on it.
you're working on it. So every penny that you spend on it, you add again to the asset balance. So هون بالcapex you
بترجع
see
بتحسب هي automatically.
you put in 72K as a start, and then every year you're adding 60K. Can you see it? 2025, 2020. These are the additions that you're making, which increase the value, so the value of the asset will increase. At the same time, it's being amortized لأن في features تانيين صاروا obsolete. So it's this one you're adding, so it's an additional investment, additional capex that is increasing the asset value, but the amortization is the accumulated amortization that will, as a book value, it will decrease. Yes, it's accounting principles. Any other questions? Okay, so we covered revenues, COGS, OPEX, CAPEX. What are we missing in terms of assumptions for you to build the financial model?
We're going to calculate the taxes, so the variable some tax bracket. Maybe it doesn't apply to companies.
Tax is usually 17%. We put it. خلاص. It's an assumption to the model, but I want another assumption.
Financing. So you can to finance these things, we're going to have to put the debts.
Yes, this will be the result of the financial model, but I'm missing one item first. Assumptions that will affect your cash flow. Later on, after I identify the funding gap.
Like the amount of time it takes to get the ratio.
Absolutely. So the working capital assumptions. Thank you. Working capital assumptions, DSO, DIO, DPO. Okay, so these are the ones. And if I'm paying dividend, Kaman, how is the dividend payout ratio that I have, and when do I do it? Here, I'm assuming I will start paying dividends in 2027. Clear? Does it make sense in terms of projections? 30 days DSO, 60 days DPO, and 10 days DIO. Comments? It's just an example, but tell me, what's your impression when you read it? 10 days DIO, too little, too high, which sector is it? Inventory outstanding, كل قد ايه بيقلب الستوك؟ Food, exactly, perishable items. DSO 30 days, DPO 60 days. What do you think of the manager?
You are getting paid in 30 days and you have an extra 30 days to pay.
Okay.
30 days of cash in your hand.
Great. Are you stretching your supplier? يعني كتير عم تطلب منه؟ لأن as a social enterprise you should pay in the case of social enterprises. بده. Okay. But 60 days, I mean, this is 2 months. 2 months is, and we're not, لأن في أوقات بيكونوا حاطين 150 days. 150 days, you're killing the supplier. So make sure that in your projections, you are projecting a healthy cash cycle for you, but at the same time, you're not stretching your suppliers too much. بدهم cash. Okay, we're sending the slides. We will be sending the slides, so you will have this step by step. We'll send the slides with the financial model template. So you'll have a step by step on how to fill it, which sheet to fill first. This is the result. So this is the financial model template that we will be sharing with you. This is the revenue calculation sheet from which you will decide which one is more appropriate for you as a model. Okay, advertising, number of outlets where you sell your product, and so on. This is the assumption sheet where you put in the interest, the inflation rate, the tax rate, the number of years of amortization, the salary structure that you have, a buffer for OPEX or for COGS. And if it's, you remember I said there might be a percentage of your time that is allocated to COGS. This is where you fill it. So if the operations guy is spending 50% of their time on COGS, we put it here. Okay, and their salary will be reflected in the cost of goods sold. This is where your revenues will be calculated. Natalie, familiar معه التمبليت? So these are the revenues, these are the cost of goods sold, and your gross profit. This is where you input the growth rate, the growth in revenues, and this is where you put in the percentage, cost of goods sold percentage of revenues. Everything that is in blue is a cell that you need to fill. It's written in the model, but everything that is white is a calculation. Here you put in the expected grants that you are targeting to get, okay, month by month and then yearly. This is so I'll take your example. You're still involved in the production. You are. How much of your? أنت أختك. So Zainab, 100% production ولا 50% production 50% business development 50%. So when I put the salary of Zainab here, so Zainab, let's call her the COO. Here I put 50%. It's a COGS related position. 50% of Zainab's time is on COGS, is related to production. بلا يعني إذا هي عم تاخد if she's taking 2K salary
يتغير ان احنا بالهاي سيزون الشهر تبعها بتختلف.
اوكي.
هاي البارت تبع 50 بتأثر او لا بتضلها ثابته.
If it's important enough we can model it. If it's important enough we can model it by month. بس هون how it is, it's just for the year of 2024.
بس
عم نقسم we're dividing her salary between COGS and salary and OPEX. No. No. Yes. You can average, you can the 50%, the 5 months a year she's 100%, 5 months she's 50%, بتحطي 25, 30, so you decide how you put it, okay? OPEX, CAPEX, so here you have the number of staff and how it will continue. You have the monthly costs, okay? Monthly batir per year, the investments, the CAPEX, and here the amortization and depreciation tables. Lastly, this is the result. This is the this is where you input the cash conversion cycle assumptions. Yeah? معي? And this is the final, this is the financial model. So it's showing you. Ouais. Yes. DPO, DIO, payables, sales inventory.
Okay, the payables. It depends on, let's say, suppliers. Some suppliers you have to pay upfront. Others you have like 30 days or 60 days to pay. And how do you put an average? You have different deals with different suppliers.
We can do a weighted average. حاعطيك example. عم اشتغل مع Made by Nature. They have suppliers that require cash payments, and they have suppliers that give them 180 days. So my question to them: how much of your sales are of your payments to the suppliers are cash versus, and then we take the cost of goods sold. عم تلحقيني؟ You take the cost of goods sold, you multiply by disons 2080, 20% times 10 days plus 80% times 150 days. Okay? Voilà. So this is the model will show you the 3 financial statements: balance sheet, income statement, and cash flow statement. This is the balance sheet projected for 2028. Okay? You're with me? Okay. Then you have the income statement. And then you have the cash flow statement. We showed examples of these once we were presenting the financial statements. And this example, look at it. They have a cash gap here of minus 3 million, 4 million. Okay, they need to bridge it. So here, once I see this funding gap, I say, okay, then we need to raise funds. I go back to the slides and show you here. So this is an example of the income statement. Okay, 23 actual, 24 forecasted, 24 budget, 28 forecasted. I zoom. You're seeing? Yes? I lost you. دي بعد عنا. Half an hour. Can you still make it? You need a coffee? So sales minus cost of goods sold, the gross profit. We're seeing how the gross profit margin is voilà. OPEX, total OPEX, EBITDA, depreciation, amortization, financial expense, and net income. Okay, what do we look at as advisors to see whether the financial model makes sense? So, does it make sense? قبل COGS sales منطقي في شيء بخوفك؟ اوكي ما بنعرف شو بزنس what
doubles every year. Wow. That's what's their margin? The share? Are they getting double?
Okay.
It's best case scenario double.
Okay. Okay, point taken. So the other question is, I need to make sure that they will be able to make this number in 2024. If they make it and they double in 2024, I'm more at ease looking after, because I don't know the growth opportunities. Maybe they're opening new outlets, and yes, if they're selling from one outlet 1 million, they can, if they double the outlets, probably they are capable of doing it, and they will continue. But this is a question we ask. Sorry? Yes, yes. Yes, so this is one question we need to see. We need to see a sales funnel for 2024 to make sure that they can make this number, and we need to understand their assumptions. How do you justify that you are doubling every year? Is it because you are growing outlets, you're going to a new market, you're adding customer segment? What are the growth opportunities that you have translated into this revenue growth forecast? Okay, next question. What do you look at in the financial model? Cost, okay. Look at the margins. 47%, 49, 52, 61. It's improving. What's the question that you need to ask to say yes or no? So imagine you're on the board of this company and you need to approve this forecast. What questions do you need to ask before you say, okay, it makes sense?
How do you reduce the cost?
Exactly.
Of production
exactly. So how can you pass from 47% gross profit to 61% in 5 years, in 4 years? Is it really economies of scale? How can you afford to do it? Okay. Then OPEX. What questions do you have?
Did you
so 12% operating OPEX are 36% of sales, 39% of sales, then they drop 33, 29. That's fine, and I'm not concerned. If I look at the allocation, I might be a bit more concerned on what? Travel is very high. I need to understand why they moved from 48 to 50 and then 144. Maybe they have it. These are questions we ask, okay? Maybe it holds the ground, because here I know the example, it's a Lebanese fashion designer. They're opening new showrooms. So the rent is that of the showroom, and here also they opened a new atelier. So here it was the atelier and here it was the showrooms. So, but we need to ask the question, because it's a big amount, big jump. What happened?
G&A expenses, يعني they passed from 2% to 5.
Yes.
إذا كلهم ضلوا على زي percent it makes sense. أوكي دايما بنحط على الماركتينج let's say 10% budget بيروح على الماركتينج.
Yes.
بس ليه فجأة البادجت تبع الجي&A كتير
مظبوط. شو فيه that what does it have that is not covered by these? So I need to understand what it is. Excellent. Financial expense. What happened here? Why do they have a financial expense here and not here and not here? Why do they have financial expense in 2024 and 5 but not in 23, 26, 27?
So they probably like paid off their debts.
Exactly. So they took on debt here. They were debt free here. So they took on debt here. They started paying it. It was a 2-year debt that they repaid here. Okay. Okay. So what does the cash flow forecast show you? It will show you the cash shortfalls. It will show you whether you will have enough money to pay for your suppliers, to pay for the salaries, for the operating expenses, and it will show you whether you are able to meet the requirements of investors and lenders in terms of principal repayment and in terms of anticipated returns for shareholders. This is the cash flow statement. How many buckets are there in a cash flow statement? 3. Cash from operating activities, cash from investing activities, cash from financing. What's happening? This is the long-term debt that we saw. And they paid it back. This is the 30,000 that they had to invest in a new, and the 250,000 that they invested in a new workshop. So هذيك كانت بوتيك هول هن الوركشوبس fixed assets.
Is this a real example with real numbers?
Yes.
So they did actually double their net sales?
Between 23, 24, yes. 25, let's see if they can make them. And it was a tough year for everyone with the Gaza war, and their sales is mostly in the Gulf, and people have pushed the brakes. So, but let's hope بعد في 4 أشهر صيفية. Okay, what else? Look at the changes in working capital. So my question to you is, look at, so he started the year with 60K, ending it in 80, thanks to a new debt. What's eating from his cash flow?
The fixed assets.
This is eating from the cash flow. The 30,000 fixed assets, yes, but this is the one eating from the cash flow. Okay? It's the working capital, and look how it increases, the change in working capital. This is what? This is inventory, mostly inventory. Okay? You see the numbers in inventory? This is inventory increasing. He needs to prepare the collection. He's a fashion designer. He needs to prepare the collection. He does prêt-à-porter and couture, so this is prêt-à-porter. He needs to have a stock of clothes that he can distribute to outlets that are selling his stuff. So the inventory, the working capital, is going back to your point on the terms that we have from suppliers versus from customers. Okay, next. Once we do the base case, what do we do? Scenario analysis. Okay, so how are we doing it here? So in the scenario, you can have a worst case scenario where you cut your assumptions to reflect a bad event happening, and you can say, what if? So this is here in the table we're showing the EBITDA. So the operating income, okay, earnings before interest, tax, depreciation, amortization. What we're saying here, what if we have a 10% decrease on revenues? Yeah? And coupled with this, we have a 10% increase in operating expenses. My EBITDA, which under the base case was 8 million. Under this scenario would be
worst case نخسر $3 million.
voila. Okay. In a positive scenario, if we are able to reduce our costs by 5% and have 5% increase on the revenues that we put, we would go from 7.9 to 13.3. So this is the scenario analysis, best case and worst case. Here we're showing it on EBITDA, here we're showing it on operating cash flow. So this is the cash that I will have. This is the worst case scenario, it will be 4.5. And this is the best case scenario, 7.5. Yeah?
وانا مش نيجاتيف في worst case مثلا.
Because apparently they have a good cash base. Okay?
They don't have, I guess, monthly. هن اللي كان
No, this is another
10
one.
days عم فكر بالانفنتوري. هن كان عندهم 10 days.
This is a different example. هيدا.
اوكي. يعني فكرت انه 10 days يعمل turn over is very good.
هيدا اللي مساعدهم look, they're incurring losses. هيدا EBITDA, so the net income is even bigger in terms of losses, but they have a good cash buffer. This is cash, operating cash flow. Okay.
اللي صوت انه example of a fashion designer عنده inventory 10 days الف واقف سريع.
عم بتساعده يحسن. So the working cycle is as it's not the same example. It's not the same example, but it could. This explains a better cash flow position in a worst case scenario. Yes, having managed your working capital cycle. Because the difference between EBITDA and operating cash flow is the working capital changes. So for this to be positive and this to be negative, it's that you are liquidating your receivables, or you are collecting your receivables, or you're getting better terms from your suppliers. So, are you able to hang in for another 20 minutes for the company valuation? بدكم break? Yeah? لأن حسيت هيك everybody.
Okay, grab a cup of coffee now.
يلا grab a cup of coffee and come. هعلل. So I will skip this. You all know why we need to value companies, because we need to determine the price when we're buying or selling, because we're adding new shareholders, because we need to obtain financing, because we are launching an employee stock option plan. So this is when you value companies. Excuse me. So, two concepts, pre-money and post-money valuation. Okay, what's the difference? So before the funding round, so here the pre-money valuation was 800K. Okay, we injected capital of 200K, and post-money valuation is 1 million. What is the new investor's stake in the company?
So 75%. Is it the person who was there before?
The one who injected 200K.
So he gets 25%. But the owner's stake gets diluted from 100%.
Yes. How did you come up with the 20? The 25, sorry.
200K is 25% of 800K, so I'm investing 800.
But the stake is not, so it's 200 divided by what? The new shareholder stake in the company. What's the new valuation of the company? What's the post-money valuation?
It's 1 million.
1 million. So his stake is what?
20%.
It's 200 divided by the 1 million.
So
Not by the 800.
The post-money valuation.
Exactly. Because he's a shareholder in the new company. Sorry. Okay. So, what's dilution? Dilution. We have two shareholders, each of them having 50% of the company. Natalie comes in and invests. Okay. she comes in with 20 million for a post-money valuation of 120 post-money, okay? So the shareholding table changes. The shareholders that each had 50% of the company now have 41.7, and the new shareholder has the 16.7. What happened to investor 1 and 2? They were diluted. They owned 50% of the company, now they are at 40%. Okay, this is the concept of dilution. من الكل unless الكل فاتوا كمان. So one way for you not to be diluted. Where is yes. Yes. Unless هذا عم جاي بقوله unless you increase your investment. يعني وقت اللي فات الثالث when you have the third investor you put in money in the company for you not to be diluted, for you to maintain your 50%. كيف يعني 10%؟ يعني هو 200 تبعه اوكي اوكي. وانت قد ايه كان عندك من المليون؟ من المليون كان عندك 50%. بس انت كان معك قبل 500,000 وهلا صار عندك 500,000 على الفالويشن الجديده. سو مثل ما عملنا هون، يعني هون اسيوم هيدا كانت it was 100 million pre-money صح؟ so 50% يعني انت حتى 50 million و your sister حتى 50 million.
لا هو ما حددت، انت بتبري 50
بس
نحن
خلينا نعملها. اوكي إلي لا عندك 1 2 3 وهلا 4.
كنا 500 400
so بهيدي هي 50% 40% 10% على توتال. اوكي
اذا بدك تسهلها حطيها 300 اذا لا مش هيطلع مليون.
هلا مليون.
حط 100 فصارت كروس فاليوشن طلعت مليون.
هيك كنتوا قبل كنتوا 900 وهلا صرتوا مليون. اوكي هول بالراوند 1 في حدا يعمل لان so 500 divided by 900 وال 300 by 900 okay. So this is round 1. مظبوط هون 12. يس اوكي. هلا بالراوند 2 صارت 500 على مليون، صارت هيدي 50 هيدي 30 هيدي 10 وهيدي سوري 10 و 20. So this is your shareholding, this is your cap table ب time 1 T1, this is your cap table ب تاني T2. في usually there are anti-dilution so بيرجع if there are anti-dilution clauses in the term sheet what you do is that this guy will have automatically new shares. Okay?
He will have to inject money to it.
So كأنه صار في credit line where the company will
No, بالanti-dilution without investing more in the company. This is one of the clauses اللي بتكون مدتها معه. And this is the one that you have to make attention to when signing the term sheet. Make sure that the investor did not request for anti-dilution clauses. We covered them during the session on Friday. لأن بالanti-dilution clause بيقول in the next funding round that you do, for me to protect, I need to protect. It's very stretched. You should negotiate and not to have it. But they will tell you in the next funding round, we need to ensure that, or if it's a down round, if the valuation here is less than the valuation here, I need to protect myself and not get diluted. So you give them an amount of shares for free for them to maintain their 50%, even though the valuation dropped and their shareholding would have dropped.
If one person gets an anti-dilution clause and the others get diluted, right?
Yes. من هيك it's unfair, but some investors might, some VCs might put it for control purposes. Yes, بس بتكون محددة for the next round if there's a downturn, etc.
Always get a lawyer to check.
Okay, this is the valuation along the investment journey. So usually what we see along the valuation, along the investment journey, remember we start with small tickets, typically by the 4 Fs.
Friends, family, fools.
Family, friends, founder, family, friends, and fools. Okay, the 4 Fs: accelerators, business angels, VCs, fools, and they're crazy enough to invest in the company at an early stage. So مجنين. Strategic investors, private equity, and IPO. The cost of equity, does it increase or decrease as you grow bigger? The cost of equity will decrease. Why? Because you're less risky. So the risk is getting lower, the valuation will increase, the risk decreases, and the cost of equity along with the risk will decrease. Okay. So step by step. First of all, look at this one. This is the amount of funding. So usually you start by raising smaller tickets, and as you grow bigger, you start raising bigger tickets. Okay? Who are the potential investors along the way? You start at the beginning, once you're still a startup and the tickets are small, who would invest? Yourself, your friends, your family, and any person who's crazy enough to invest in your company at this early stage, the 4 Fs. Okay? Then accelerators will come. The Beritech, the Flat 6 Labs, the EVB accelerator, the LAU accelerator, they will come and they will invest. The term sheet that we showed on Friday was a term sheet of LAU. Okay? Then business angels, these are people with deep pockets. Constantin is a business angel from the Lebanese diaspora. There are many people like Constantin who are retired, they have the means, and they're willing to invest in companies. And we've invested in 10 SEs last year. So these are business angels, people with money who would like to invest on an individual basis. VCs are venture capital. So these are funds that are there to invest other partners' money, other investors' money. So a group of investors invest in a VC, the VC invests in different startups. Strategic investors, I don't know, if the Bane would like to buy stakes in Garbalizer and add it to its product offering, this is a strategic investor because they're both in agri, both in fertilizers, pesticides, and so on. Then private equity. Okay, and then IPO is initial public offering, yani when you're going, when you're starting to be listed on the exchange. Private equity is like VCs, but it's for more mature companies. So it's also a private equity firm. It will have its own investors who invest in a pool, and the private equity fund will invest in different companies. But unlike VCs, who invest in startups. PEs, they invest in established companies. They will go in, buy majority shareholding in the company. Majority. They would change the management team, they will change the strategy, revamp it, and sell it at a higher valuation in 5 years when they're out. Voilà. بس الفرق هون هو السايز. هون startups, هون mature organizations. And then IPO is you take the company. So what happens? So we covered the amounts and the nature of investors. What happens also is the risk. The highest risk is when you're still small, right? And once you grow, خلاص you prove that you are outside of the death valley اللي بنسميها. You made it. You proved your model and you made it to profitability. So the risk decreases. Therefore, the cost of capital for you to have investors here will decrease. So هون the return on equity that, you know, as an investor investing in a startup, I need to have a required return on equity that is high enough to justify the very high risk. Okay, so هون cost of equity is cost of capital basically. The lower the risk, the lower the cost of capital. And the valuation, as you increase, the valuation will increase. So here the message: if you're raising capital, and we said it on Friday, if you need 300K, raise 300K. Don't raise 500K at a low valuation. Okay, raise the funds that are needed just for you. بنسميهم the runway needs. What that you need now, and then wait until your valuation improves, increases, and then you do another funding round of a higher valuation. Why? Not to be diluted. Okay. Or not to be as diluted.
How do we calculate the cost of equity? It's basically how much people, if a company is worth 100 million, it wants to raise 10 million, now the cost of equity is 10%?
No. The cost of equity is related to the market. So take in Lebanon, what is the cost of equity? What is the sector you're working in?
It's the risk.
It's the required return. That's the discount rate. Okay, it's the required rate of return for equity investors, which is a function of the market, of the sector اللي أنت فيه, of the country اللي أنت فيها, and the size of your company. Okay. Valuation approaches. So, what are the valuation approaches? When we talk valuation, we talk about ranges. So there's no one valuation that you will get. You will use different methods of valuation, and from each method you will get a valuation, and you will have therefore a valuation range. So we will say that the valuation of the company ranges between 2 million to 2.3 million. Because one method gave me that, another gave me that, so the range is between 2 and 2.3. The other thing is that there's an average. So I do the different methods, and I look at the valuation that each method will give me, and I take the average. Okay? What are the methods? And each method is applicable based on the stage of development of the company. When we're looking at large companies, these don't apply. So we do immediately DCF, comparable, and net asset value. Early stage, the idea stage, for example, those three methods are more, the weights are more, and they are more appropriate than those valuation methodologies. But we do them all, okay? So this is an example where we're looking at a valuation range or an average valuation based on different methods. So I take one company, I do, let's say it's a startup stage, I do the scorecard approach. I will give it a factor of 15%. The cost to duplicate, I will give it a factor of 15, and I will give the VC method, the DCF, and comparable method 20, 30, 25, and I'll do the net asset value, and I'll give it a weight of 15. So every valuation from each of these, I multiply it by its corresponding weight, and the average valuation is that of the company. This is one approach, okay? When you sit with investors, it's a negotiation. You will show them the results of your valuation based on different methods, and then it's a discussion. But this is one way of saying, okay, these are the different methods. This is the scale that we adopted for different valuation, different development stage of the startup or of the company. Here it's a mature company. I will not waste my time on these methods. I will only do these three. Clear? I will explain each of them, but clear as a concept. So we're talking valuation range, we're talking valuation average based on different valuation methodologies. So the first one, scorecard with checklist, these are early stage valuation approaches. So for very early stage startups, we use them. They're very similar. What we do is a subjective assessment. We look at the team, we look at the opportunity and the potential of scalability that it has. We look at the competitive environment, at the strength of the product or service that the company is offering, the strategic relationship that they have with partners. Go back to the business model canvas yesterday on Friday, where we listed the partners and what kind of relation we have with them. So this is one component, and the funding required. And there are weights for each of those criteria. And assuming that I put 80 over 100 for the team, I put 50 over 100 for the scalability potential, 40 on the market because it's very competitive. The product is very strong, so I gave them a 90 over 100. The strategic relationships are okay, 70%, and the funding required is 40%, 40 over 100. Again, subjective, okay? So this is my grading. These are my weights, and accordingly, the company valuation is, the benchmark that I use is 5 million. So here I looked at the market and I saw that a benchmark, a comparable of this company in the market is valued at around 5 million. Okay, so given that these are the scores that the company got, and based on this valuation, I will calculate the company valuation and I'll take the average. Clear?
This is a company that is of the same size.
Of the same size, same sector, same country, very comparable to it. Okay?
Strength of the team, 30% weight.
30% weight. So for me, I give it 30% importance. And when the company came and pitched. The company came and pitched, okay? I listened to their pitch, they introduced the team, I need to score them. I score them based on this criteria. And for me to give them a final grade, this is the scaling factor I'm using. So for me, it's the most important factor is the team, because it's still idea stage, eh? So it's very important for me to know that the team can execute.
And this number, 30%.
30. أنا حطيته for the investor. For the investor. It's very subjective. Yes. Yes. Okay. But I'm justifying to tell you that at an idea stage, what's the most important thing? Whether the team can execute or not. Okay. So I give it a 30%. While for me, the strategic relationship with partners at this stage gets less importance than the size and scalability of the potential.
Like 3 to 50 is the sum, not the average, right?
3 to 50 is the company valuation.
So the sum of the values above.
Yes. Each of them took 30% times 80% times this gave you this. And then the total is 100. So this is the total valuation of the company.
And the SLD score is?
This is my rating of it. So I gave 80 over 100 for the team. Okay, 80 over 100. Clear? Okay. The checklist approach is the same, but instead of having a benchmark, I say in this market in Lebanon today, the highest valuation this company could have is 5 million. Again, very subjective. But knowing the market, being investor active in this market, I can know today in Lebanon, I will not give for a company this size at an early stage, I will not give a valuation. Best company with the best team, with the best idea, with the highest scalability potential, the most attractive market would get a 5K. I'll give this one that just pitched to me, I'll give it a 3.4 million K. Clear? Okay, this is very early on, pre-revenue, because you don't have revenues to be able to quantify and.
From a like market sizing perspective, if you're the investor, what does it look like when you're trying to see either the benchmark or the max valuation? I mean, from your perspective, if you're going into a market and you want to know the benchmarks, do you go for like market research firms that do this market research? If I'm a startup and I want to do the market research, how do I find these numbers? What's the typical market research required for these numbers?
From a VC point of view, from an investor point of view?
From an investor, also from a startup. So usually, like, we're asked to do the valuations ourselves.
Yes.
So we're looking into the market and we're looking at competition. What does it typically look like when we're looking for these numbers? What are the sources?
نرجع نقول this number or these numbers?
The 5 million.
The 5 million? From the knowledge in the market. يعني for you, for example, you take, I don't know, Nadira, and you say what is Nadira's valuation in the last funding round. And we're still, as sustainability, we still have some room to grow to become, to get the number of sales that Nadira did. So for me, Nadira is a good benchmark. The valuation on the last funding round was 5 million, I put 5 million.
Okay.
Yeah?
So, okay.
Another pre-revenue, other two pre-revenue approaches are the VC method and the cost to duplicate. I start with this one. I just built my startup, okay? For me to do it again, what would I incur as costs? I will pay 60K in development costs. I need to purchase a software for 10K. I'm duplicating my startup, okay? So I'm saying to duplicate my startup, how much it would cost me. I need to pay the founder's salary for the past 12 months that I paid. So this is 12 months of salaries, 12 months of operating expenses, legal setup cost of 15,000. So the total is 131,000. This is the valuation of the company. This is very simple as a valuation approach. So this is the cost required to recreate the company. This one is the VC approach. We look at the EBITDA of the last projected year. So we did the financial model, we did the projection. The EBITDA of the last of 2028 was X. I multiply it by the multiple, by the industry multiple for EBITDA. So EBITDA multiple, they're listed, we know them. And then I discount it, but at a very high rate, depending on the stage of development. If it's idea stage, the discount rate can range between 50 and 85. So again, I take the EBITDA of the last year, I multiply it by a multiple, اللي هو multiple of valuation of price to EBITDA. Okay, you know what multiples are? Okay, there في شيء اسمه multiples. Multiples showing price to revenue, price to EBITDA, price to earnings. These are ratios اللي هن البرايس تبع الكومباني, the valuation of the company divided by the net income, or valuation of the company divided by EBITDA, or divided by revenues. So in the VC method, I take the EBITDA of the last year, I multiply it by the EBITDA multiple, which is there in the industry. We know that for the goods. مظبوط. For retail مثلا, the typical EBITDA that we see is X for price to EBITDA. For the construction industry, price to EBITDA is X. So I take the EBITDA of the last projected year, I multiply it by the multiple, and I discount it back, and this is the last year, in 5 years. I discount it back, but not at 10%, not at 15%, at 85%. I'm killing it, okay? And if it's a bit more developed, the discount rate could be 25 to 35, but still I'm discounting big time because I'm You know, this is the aggressive valuation methodology. So this will give you the valuation for the VC method.
But as you said at the beginning, typically they do all of the methods and then they give them weights, right?
اللي هو this. This is the scorecard or checklist. This is the cost to duplicate. This is the VC method. هلا we'll cover these three.
So it's never fair for one, like for an investor
No.
to come and apply only one.
No, no. But VCs do. VCs apply this one.
Just this one.
And they look at different ones, but they mostly apply this one. This is the VC method. Okay. Now, for growth and maturity stage, we look at the asset approach, the income approach, and the market approach. The asset بس حلوة الغنية. أنا بناتي الصبح عم يسمعوا شو اسمه؟
عربي أجنبي.
لا أجنبي تايلور سويفت. تايلور سويفت على الصبح دج 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 أنا يا محلى فيروز.
هذا عمرهم؟
10. So net asset value, discounted cash flow, and the comparables. هون we're looking at the multiples. Okay. هون we're doing the financial model and then we're discounting the cash flows. Here we're looking at assets minus liabilities book value. I'll skip this. So this is the asset-based approach. Total assets minus total liabilities. Okay, market value, so not book value. So I adjust. So for property, I do the revaluation to know the market value, and I add goodwill, اللي هو the premium that I would pay for brand value, because this is l'artisan du Liban. This is not any other, and this is the valuation. This is a very basic approach. Exactly. So this is a very basic approach. The discounted cash flow, it's from the concept of the penny today is worth more than a penny in 5 years. So the cash flows that I'm getting in 5 years, I need to discount each one of them until now. So I start with my earnings, I adjust for depreciation in order to get to what we call the free cash flow. And I take the free cash flows for the 5 years on the horizon. I come up with a terminal value. Okay, I won't go into details, but the terminal value takes an assumption on the growth rate and on the discount rate. So I take the last free cash flow, and I assume that from now on, every year I will have a growth rate of X for my free cash flow, and it's a perpetuity, it continues. Okay, and then I take, for each of those, I do the discounting. And the enterprise value would be this amount. So this is the equity value. I adjust with the debt, so this is my equity value. How do I discount? Using a discount rate. What is the discount rate? This is the cost of equity. We start with the risk-free rate of the country, equity risk premium, size risk premium, industry risk premium, company-specific premium, and this is the cost of equity, which is very high, 23. In Lebanon, the cost of equity is much bigger. The cost of debt is around 12, 15. The cost of equity is much higher. And the WACC, which is the discount factor, is taking into account and the cost of equity and the cost of debt, depending on the capital structure. Don't expect to leave from here, go to your offices and do the company valuation, okay? Just to give you an idea, none of you, I'm assuming, will be raising equity capital soon. It's just to give you an idea, along the investment readiness journey, this is something that will come. So this is why we're covering it. The market approach, so we look at either precedents. So we know that Nadira did this funding round and the valuation was X, and their EBITDA was Y. So what was the multiple on which they were sold, or they sold shares? So this is precedent. And comparable, it's for publicly listed companies. So we know that Facebook is listed and the P2E, price to earnings of Facebook, is X. Then I apply it to my company. Of course, I do a discount to account for the fact that I'm not Facebook, I'm not in the States, and so on. So this is an example. You have those market multiples for comparable company 1, 2, 3, and 4. Okay. This is the price to revenue. It's ranging from 4 to 8.5. This is the price to EBITDA ranging from 10 to 18, and the price to earnings ranging between 19 and 47. So for my company, based on these multiples, my revenues are XYZ. So my valuation based on these multiples, or the average of these multiples, based on the revenue multiple, it's 8.5. Based on the price to EBITDA, it's 7.4. Based on the P to E, it's 7.1. So the average of those is a valuation of 7.7. I lost you, Walla, it's clear?
No.
Just take the concept, exactly. An idea, you're not supposed to. Okay.
This is the price per share.
Sorry?
The price per share.
This is the price to earnings. So price per share divided by earnings per share. And this is usually for companies that are listed. Yes. So you have it for Facebook, Instagram, and so on. You're a company that's trying to replicate this model, you take it. You don't directly jump to here. If you're not in the States, you're in Lebanon, you're trying to do this, you apply a discount factor. As the P to E in the States is 28, in Lebanon it cannot be, you have to apply at least a 50% discount. Okay?
Who comes up with the discount rate? Is it like
We do, your financial advisor does. By seeing how the PEs in the States compared to the PEs in the Gulf, compared to the PEs in Lebanon, compared to transactions. This is why when you're doing a valuation, you need the intervention of a third party neutral, which is typically a financial advisor. Of course, you need a third party. We were talking about this last week with the team. You need a third party who's objective, who can come and defend you versus the VC fund that is coming to hit the valuation, and for the transaction to be fair. Any questions? We just went very quickly over the valuation methods. I realized, so a huge disclaimer, you're not going to be an expert in valuation from these 15 minutes, but just to give you an idea of what are the valuation methodologies, how are they done, to which stage of development of a company they are done, and what are the assumptions behind it that you need to be to get hold of. Maybe just a few tips. So number 1, reach out to an external financial advisor. Okay. 2, different valuation methodologies, and then you will reach an agreed mutual valuation range. Different scenarios and sensitivity analysis, best, realistic, worst, on the discount rate, on the working capital assumptions, on the growth rates, on the gross margins, on the growth rate and revenues. All of those, because when the discounted cash flow valuation is based on the financial model. So any change in the assumption on the valuation on the financial model will affect the valuation. Yes? Benchmark your assumptions with similar businesses, sectors, and geographies. Account for risk factors that might impact the future cash flows. Balance the valuation result with the value added of the investor. It's not only about money. Once you have someone coming in your cap table, this is a shareholder, this is a partner, this is someone who's sticking around. You need to have alignment in values. You need to understand that they're not only injecting money, but they're going to have a value added to your company in terms of strategic support, in terms of financial support, in terms of support to the network that they can give you access to. Non-financial considerations such as brand, such as reputation, such as strength of the team, the relationships that you have established, and do not aim for perfection. And I will end on this song. Thank you so much. Thank you for staying. Thank you for listening. Thank you for your patience. And we look forward to having the other focus sessions with you. So what you're expected to do in those sessions, bring whatever you would like to share with us. Constantin and I will be on the call. You will present either your pitch deck or your valuation or your financial model or the strategy for 2025, or the mapping of growth opportunities that you have, or the balance scorecard that you would like us to review. So any topic that you like to share, you will do it with the group. So we will be sending slots for every social enterprise, a time slot, but we encourage you to come to the whole session. It will be a session by group. So for sustain, for the developed sustain and alone, and for the seed and the early stage sustain alone. So this is how we're splitting the groups, and then the sessions per group will be running for 3-4 hours, but we will have slots for each one of you. You come, you present, we provide feedback, but the rest of you being present will be able to benefit from the feedback that is given to everybody else. So we encourage you to come to the whole session to learn from the other examples, and then after those 2 sessions we will have one hour coaching session with each one of you to go more into detail, to review another version, another topic that you would like to discuss with us. So for now, 2 sessions on for you to come present, take feedback with the group, and then 1 session one-on-one, 1 hour with Constantin and I. Yes. مش دعاية هيدا. لا online. No, these are online.
So just 2 sessions will be one group for pre-learning stage and growth.
Yes. We haven't. So today or tomorrow, Sabine will be sending an email assigning you to group 1 or group 2, and sharing with you the schedule. It's either Monday or Thursday, next Monday or Thursday. And the one after is, so 2 sessions per group, 1 next week and 1 the week after. And then we agree, us and you, on the coaching session, on the 1 hour coaching session. The demo day will be on September 3rd. It will be here. We will have a jury. We will have investors invited, and you will pitch. And if you're really looking for funds, pitch, because we will invite investors that might be willing to. Nice, نجيب gâteau. We'll have a cake then. There will be impact investors, so mostly business angels that have a mandate to invest in Lebanese social enterprises. So be ready to pitch and really ask for fundraising during the demo day. No, it's not a demo day. Make use of it. Voilà. Thank you.
Thank you, Lama.